Hello dear CA final students, I hope your preparations are going well. In this video, we are going to revise one of the very important chapters, financial instruments, where we'll be discussing all the important concepts, important past paper questions and study material questions, and also newly added questions in our study material by ICAI for this May 2025 attempt. So let's get started. So three standards together, that is 32, 107, 109, three standards together gives the guidance for this financial instruments accounting, financial instrument presentation, how this will be presented in balance sheet and statement of P&L, other financial statements is what given in 32. Disclosure in notes to accounts is taken care of by Ind AS 107, and recognition and measurement is taken care of by Ind AS 109. Okay, so three standards together, 32, 107 and 109. So starting with, what is the meaning of financial instruments? What is the meaning? What is the meaning of financial instruments? The moment I'm getting into the standard says there should be a contract. Then only the standard becomes applicable, because financial instrument definition itself, financial instrument is your chapter. So what is financial instrument? It is a contract that gives rise to financial asset or financial liability. So there should be a contract, that is a prerequisite. Okay, prerequisite is a contract, I understood. So if there is a statutory obligation, income tax payable, is it a financial instrument? Income tax payable? No. If you have deposited some amount in locker, bank locker, you deposited 50 sovereigns of gold. You have put 50 sovereign of gold in bank locker. There is no contract between you and bank that 50 sovereigns of gold will be safe. If it is lost, we will pay you. Is there any such contract you have entered into with the bank? No, this is not a financial liability for bank. This is not a financial asset for us. Gold is our asset. Okay, and if I have gold, I have not deposited anywhere. Is gold a financial asset for you? No, there is no contract. There is no contract with any party. Okay, so to constitute it as a financial asset or financial liability, rule number one, there should be a contract. So contract requirement ആയിട്ട് വരുന്ന മൂന്ന് standards ഉണ്ട്. You know what are the three standards? One is financial instruments, 109. Then 115. Then one more standard, 102. Very good. Only on grant date. Grant date is the formal agreement date. Grant date is the formal agreement date. Okay, perfect. Now, so financial assets, types and accounting. So these two areas are basic: financial assets, types and accounting. So we are moving on to financial assets. What are financial assets? We have seen there are 5 items: cash, investments in equity shares, contractual rights to receive cash or exchange financial instrument like derivatives, or receive entities on equity shares, which can be a derivative or non-derivative. Okay. Now, what is the accounting of this financial asset? So we are studying financial asset accounting. First step, at the time of initial recognition itself, at the time of initial recognition itself, identify whether the financial asset is an amortized cost or FVTOCI or FVTPL. Whether it is amortized cost, FVTOCI or FVTPL. Okay, so you all must be remembering, but still, what is amortized cost category? If the intention is to hold it till maturity and collect only contractual cash flows, SPPI, solely payment of principal and interest. Principal and interest. Now there is a doubt. There are loans with no interest. So is it a financial asset categorized as amortized cost? Yes. Contractual cash flows you should receive. Maximum contractual cash flows can be principal and interest. Okay. So it's not compulsory that both principal and interest should be there. Maximum principal and interest could be there. That's it. These are the contractual cash flows identified. Okay, so then you categorize it as amortized cost. Got it. Now, FVTOCI. FVTOCI held till maturity also with an intention to sell. So, maximum cash flows you are expecting is contractual cash flows and also the sale proceeds. And also you are expecting to get the sale proceeds. Also you are expecting to get the sale proceeds. FVTPL. What is not amortized cost and what is not FVTOCI will fall in FVTPL category. Generally, all investments in equity shares are FVTPL. Investments in debt instruments held for trading are FVTPL. Derivatives are FVTPL. So FVTPL includes all other investments. Generally, investments in equity shares by default FVTPL. Investments in debt instruments held for trading. Investments in debt instruments held till maturity, no intention to sell, amortized cost. Investments in debt instruments held till maturity with intention to sell is FVTOCI. Investments in debt instruments held for trading is FVTPL. Okay, and all derivatives by default falls under FVTPL category. FVTPL category. Now, what is the accounting of this amortized cost? One second.
Recording in progress.
What is the accounting of this amortized cost? So by just say I want to try one questions on this. So first amortized cost category. Amortized cost category initially measured at fair value plus transaction cost. Fair value plus transaction cost. Initially measured at fair value plus transaction cost. Okay. Now, what is fair value? What is fair value? Is it market price? What is fair value? If the transaction is at market terms, everything is at market terms, then transaction price is the fair value. What is the price at which, if I am buying something from the market, I bought it at rupees 100. 100 rupees is my transaction price. Transaction happened at 100 rupees. So that is my transaction price. So transaction price itself is the market price. Transaction price itself is the market price. But if the transaction is at off market terms means influenced transaction or concessional prices, discounted prices, then, so we are talking about financial asset accounting, financial assets. If at off market terms, you should calculate transaction prices, not the fair value, because transaction price could be something else. So here it is present value of cash inflows. Yes, present value of cash inflows, because we are talking about financial asset. For asset, there will be inflows. Inflows discounted at market rate. Okay. So first step is measure asset at fair value plus transaction cost. My first step is measure fair value plus transaction cost. Then prepare amortization table. Difference between fair value and transaction price should be accounted based on the substance of the contract. That is not clear for me. So that is, what are your familiar transactions? If employee loan at concessional rates, then transaction price minus fair value is accounted as quickly prepaid employee cost. prepaid employee cost. Then lease transaction, security deposit, transaction price minus fair value is equal to prepaid lease rentals. Then holding company to subsidiary company loan at concessional rates. Difference is accounted as investment in subsidiary. Now maximum two unrelated companies. Concessional loan to unrelated, no relation. Concessional loan to unrelated companies, prepaid business expense. That's it. Prepaid business expense. These are the common areas which we normally get. This is prepaid business expense. That's it. So difference should be accounted based on the substance of the contract. And in prepaid, employee cost will be amortized over contract period or amortized over contract period. Okay, lease rentals will be amortized equally. This prepaid employee cost will be amortized. Employee cost to prepaid, employee cost to prepaid, employee cost to prepaid, employee cost to prepaid over the amortized over the contract period. Prepaid lease rentals will be amortized over the contract period. Prepaid business expense will be amortized over the contract period. But investment in subsidiary will not be amortized. Investment in subsidiary will not be amortized. Investments in subsidiary will not be amortized. Are you okay? Yes. Now, this is easy. This is clear for us. We remember this. Okay. If you remember this, I want to try just that one prepayment question. Prepayment. So it covers accounting of amortized cost and also just one question having that adjustments, prepayment question. So that is quickly, I'll solve this. Mm. Okay. So this question, prepayment question we are taking. Question number in your study material, it is TYK. Time being, let me take this. 2 times exam question, that is January 21. This one. So this question came in. So this is your TYK question, study material. This came in January 21 for 14 marks, July 21 for 14 marks. So I'm going to try this if from amortized cost. Okay. Wheel Company Limited has a policy of providing subsidized loans to its employees for the purpose of buying or building houses. Okay. Mr. X, who's executive assistant to the CEO of Wheel Company Limited, took a loan from company on the following terms. So a company has taken loan, see, company has given loan to employees. So Mr. X is an executive assistant to CEO is taking loan. What is the amount of loan taken? 10 lakhs. Interest rate 4% for the first 4 lakhs and 7% for the next 6 lakhs. Starting date of loan 1st January 2011. Tenure is 5 years. Prepayment, full or partial prepayment at the option of the employee. Full or partial payment at the option of the employee. The principal amount of loan shall be recovered in 5 equal installments and will be first applied to 7% interest bearing principal. What does that mean? When you make the repayments, your 7% interest keeps reducing. Okay, because 7% interest keeps reducing. Accrued interest shall be paid on annual basis. Mr. X must remain in service till the term of loan ends. Market rate of comparable loan is 12%. Following table, we don't want any table. So there are 2 more tables given which makes this question very lengthy, and PV factor take up to 6. Okay, fine. So this is your study material question. So here I need information only up to this. Only this information is required. Loan is 10 lakhs. Interest rate is 4% for 4 lakhs and 7% for 6 lakhs. Tenure is 5 years. You can prepay, and principal amount is prepaid in 5 equal installments. 12% is the market rate of interest. Shall we quickly try? 10 minutes is our target amortized cost. Okay. So first, what is my first step? Computation. So if you want, see, if anybody don't have this question, loan amount is 10 lakhs, repayment 5 equal installments, interest 4% up to 4 lakhs, 7% on balance. Market rate is, only these information is required. Market rate is 12%. Then what is the date of prepayment? Long term ends. Okay, fine. Now prepays the loan on 31st December 2012. 31st December 2012 means 11th, second year. Prepayment of 2 lakhs at year 2. Term 5 years. This is the question. I need information only up to this. So my answer. So I want everybody to try this. My step number 1. Step number 1 is fair value of loan is equal to present value of cash inflows discounted at 12%. Therefore, year 1, 2, 3, 4, 5. What are the actual cash flows? Actual cash flows we'll find out. Principal 2 lakh, 2 lakh, because 10 lakhs, 5 equal installments, 2 lakhs, 2 lakhs, and 2 lakhs. Interest, first year interest will be on 10 lakhs. First 4 lakhs, 4%, means 16,000. Next 6 lakhs, 7%, 42,000. First year interest is 58,000. Yes or no? Second year interest is 8 lakhs. First 4 lakhs, 4%, that is 16,000. Next 4 lakhs, 7%, that is 28,000. 16 plus 28. Eventually, see, in exam hall, we are calculating all this. So please try, okay. Then next 6 lakhs, your interest is first 4, 16. Next 2 into 7%, 14,000. It is 30,000. Then last 4, 16,000, 8,000. 2,58,000, 2,44,000, 2,30,000, 2,16,000, 2,08,000. So we'll discount at 12%. 0.9. I'm taking only up to 3 factor. 8, 9, 3, 7, 9, 7, 7, 1, 2, 6, 3, 6, 5, 6, 7 into 0.893 equals M plus 2,44,000 into 0.797 equals M plus 2,30,000 into 0.712 equals 2,16,000 into 0.636. 2,08,000 into 567. What is the fair value of the loan coming to? 8,43,934. Okay, 8,43,934. Now, transaction prices. Loan amount is transaction price 10 lakhs. Therefore, prepaid employee cost. One lakh 56. Figures are different, I think. 843,934. 1,56,066. To match with this figure, it is. Let it be different. Up to 4 factors, 5 factors, 6 factors, figures will be different. It's okay. Then step 2. Amortization table. Step 2 is amortization table. For amortization table, we do only up to, when we prepare amortization table at the time of prepayment, we do only for how many years? We'll do only for 2 years, because after that it is changing. So year 2. Opening balance is 8,43,934. So as we always say in class, what does this mean? This 8,43,934, why you call it as fair value? Because instead of giving to employees, if you have given loan to others, if you have given loan to public, if you have given loan to public under the same terms, 2,58,000 first year, 2,44,000 second year, 2,30,000 third year, 2,16,000 fourth year, and 2,08,000, to get this cash inflows at 12% interest, the amount you required to pay to public as loan was only how much? If you have given 8,43,934 to public today, to an unrelated party today, 8,43,934 if you are giving, then at 12% you would have received the same repayments. That is the concept. Yes. Yes. So you paid extra, that is employee benefit expense. That is why we treat it as employee benefit expense. Yes, yes, yes. So 8,43,934 into 12% is the interest unwinding or interest 1,01,272. First year we got the repayment 2,58,000. 43,934 plus 1,01,272 minus 2,58,000. 6,87,206. 6,87,206 into what is the interest? 82, 465. First, second year repayment. You prepaid 2 lakhs. But prepayment, remember, here the point to be remembered is even if there is prepayment in the amortization table, only the expected outflow should come. Because prepayment should be accounted separately. Prepayment should be accounted separately. Prepayment should be accounted separately. It should not form part of my amortization table. Yeah, I remember that. Okay. 5,25,670. Okay. What is your step number 3? If we are passing journal entries after working notes, your next calculation should be required closing balance. What is the required closing balance after prepayment? Required closing balance after prepayment is equal to present value of Parne. Present value, it is equal to present value of dash. After prepayment, the required closing balance should be present value of after present value of remaining cash flows. Present value of remaining cash flows discounted at 12%. Present value of remaining cash flows discounted at 12%, which means there is only year 3 and year 4 left. Because 5 years was the cash, 5 years was the long term. Year 1 you paid, year 2 you paid, year 2 you prepaid. So there is only year 3 and year 4 left. So how much is your outstanding loan? I forgot. Say 10 lakhs was the loan amount. First year you paid 2 lakh 58 with interest. Second year you paid 2 lakh 44 and also you prepaid 2 lakhs. So what is the remaining cash flows now? What is the remaining principal now? Remaining principal is? Principal outstanding is only 4 lakhs. So 4 lakhs. First year is, so 2 lakhs. 2 lakhs is the principal repayment. Interest is 4 lakhs into 4%, 16,000 and 2 lakhs, 8,000. Yeah. So this should be discounted at PV factor at 12% for first year. Why you wrote like this instead of factors? Because if I write if we are not specifying the factor, you may think year 3 factor, year 4 factors to be taken. Are we taking year 3's factor or year 4's factor? No, because year 3, just to identify it as year 3 payment, we have written it as year 3, but you are standing in year 2 now. From year 2, the time gap is only 1 year. Manslayo. From year 2, next year prepayment. Year 2, it is second year prepayment. So you should take the factors, first year factor and second year factor. Point 893, 0.797 എടുത്തോട്ടെ. Total is 3,58,660. Why do you calculate this? Why do you calculate this? 3,58,664. Why do you calculate this? Because actual book value before prepayment. If there was no prepayment, my actual book value is 5,25,671. Required book value after prepayment is 3,58,664. Therefore, loan amount to be adjusted. Loan amount to be adjusted is 1,67,007. Are you clear? Loan amount to be adjusted is 1,67,007. So, therefore, at the time of prepayment, what is the journal entry at the time of prepayment? At the time of prepayment, the journal entry should be bank account debit. Bank account debit. You got 2 lakhs. How much only can be adjusted against loan? 1,67,007. Balance should be adjusted against 32,993 should be adjusted against what? Prepaid employee cost. Are you okay? Yes. So if there is no change, then there is no ഒരു രസമില്ല. അപ്പോൾ here what are the journal entries to be passed? Starting journal entry is, these are my working notes. Up to this are my working notes. These are my working notes. So first I'm passing the entry loan account debit 8,43,934 to bank 8,43,934 minus 10 lakhs. Loan given is 10 lakhs. So 1,56,066 is recorded as prepaid employee cost. First year end, bank, we are getting a repayment of 2,58,000. Of which how much should I record as, class you can pass the entry bank to, you can pass split entries as loan to interest, bank to loan. You can do split entries. So here interest income is equal to 1,01,272. 1,01,272. Loan to interest 1,01,272. Bank to loan 2,58,000. Instead, we are passing single entry bank 2,58,000 to interest 1,01,272 to loan balancing figure. Okay. So first year end, repeat. Second year end also pass the, and we should not miss out. This 1,56,066 divided by 5 years. 31,213. Second year, bank account debit 2,44,000. You record interest from the amortization balance to loan and prepaid employee cost 31,213, 31,213. And in the second year, apart from this normal entry, there is an additional entry. Additional entry is then additional entry for prepayment. Bank account debit 2 lakhs to prepaid employee cost which we calculated and loan. So that is what we have written here. Not bank account 2 lakhs to loan to prepaid employee cost. And then rest. So now the loan is standing at 3,58,664. If I amortize this 3,58,664 for next 2 years, it will be closed. It will be cancelled. Finally, full nil balance will be 0 after 2 years. Yes or no? 3,58,664. If I unwind interest, repay 2,16,000. Second year, unwind interest 2,08,000. It will be 0, nil. Okay, so nothing. Here we had an extra adjustment, required closing balance after prepayment, and adjustment of loan to be made. So that takes care of this question. Prepayment. If there is a prepayment, what is the accounting in case of amortized cost? Okay. What if loan account is asked? If for exam you are getting a loan account, prepare employee loan account in the books of the company. Then if loan account is asked, loan is asset, so loan to bank. How much only will come as loan to bank? 8,43,934. Yes. Loan to bank. So this is beginning 1st April or 1st January. 31st March, loan to interest from the amortization table. By bank, first year repayment 2,58,000. So by balance carry down. Second year, 1st April next year, to balance brought down to interest by bank. You will repeat like this. Yes or no? Is it clear? It can be an ledger account, it can be a asset account ledger, or it can be journal entries along with the calculations. Okay, it is clear, I hope. Now, amortized cost. Amortized cost, we've just tried one question, and amortized cost, 1 second. Question number 22. So this question number 23, not practice questions ആയിരുന്നില്ല. In our book also there was a practice set of questions. So it's not in practice questions. So here Question number 23. I want to read this question. Question number 23. So please listen. Entity XYZ Limited enters into a fixed price forward contract to purchase 1 million grams of copper in as per expected usage requirements. Okay, XYZ enters into a fixed price contract to purchase 1 million kilograms of copper. The contract permits XYZ to take physical delivery of the copper at the end of 12 months and to pay or receive net settlement. Oh, this is how do you treat forward contract? The question. അതിനോട് ചേർന്ന് തന്നെ ഒരു question. Yes. രണ്ട് parts ഉണ്ട്. അത് second part. On 1st January 2005. Listen. വെറുതെ ഒന്ന് just relax. Just please listen. Okay, if you don't have the question also, just listen. On 1st January 2005, Entity A originates a 10-year loan for rupees 10 lakhs. Originates a 10-year loan for 10 lakhs. Okay. Loan carries annual interest rate of 7%. And it is repayable at par at the end of year 10. Entity A charges 1.25%, that is 12,500 non-refundable loan origination fee to the borrower, and it also incurs to 25,000 in direct loan origination cost. Contract specifies that the borrower has an option to prepay the instrument and there is no penalty will be charged for prepayment. The contract is classified as amortized cost. At the inception, entity expects borrower not to prepay. What is the carrying amount of initial recognition? What impact does the prepayment feature has on the amortized cost calculations? What is the carrying value of this loan? Entity A originates a 10-year loan. Now A expects borrower to pay. Is A borrower or lender? Entity A is borrower or entity A lender? Lender, given loan, lender. So carrying value of loan is, so for me it is an asset, 10 lakhs. That is a transaction cost. Transaction cost for, what I need to be careful is carrying value of loan is 10 lakhs. Okay. Transaction cost to be incurred by the borrower is 12,500. Not by me. This is not transaction cost for lender. This is not a transaction cost for lender. It is a transaction cost for borrower. He incurs 12,500 and I am charging it from him. And cost incurred by me is 25,000, which means net transaction cost incurred is only 12,500. Therefore, carrying value of loan is 10 lakh 12,500. Did you understand this? Here I should not add both 12,500 and 25,000 to the loan as transaction cost. Did you get this? Should I explain once more? മനസ്സിലായില്ലെങ്കിൽ once more എന്നൊന്ന് പറയോ? ഒരു gap. There was also a break. That is why. Okay. Means once more. See, that is the loan is 10 lakhs. Okay. 12,500 loan origination fee to be incurred by the borrower. Borrower to incur that 12,500, which means what is my transaction cost? What is the concept of adding transaction cost? What is the concept of adding transaction cost? I have given 10 lakhs to you. I am incurring 12,500 means രണ്ട് outflows alle. There are two outflows. Here is 12,500 an outflow to me. Is that 12,500 an outflow for me, for the asset originator, for the lender? Is 12,500 an outflow? No, 12,500 is an inflow. 12,500 is an inflow. 12,500 is an inflow. Okay. So 10 lakhs I have given. I got 12,500. And also I incurred 25,000 cost, which means my net cost is 12,500. So my net outflow is 10 lakh 12,500. So the carrying amount of loan is, assuming there is no other market value, market rate of interest is given. So 10 lakhs plus 12,500. This is the carrying value of loan. Then what is the impact of this prepayment feature has on amortized cost calculations? Prepaid, if there is prepayment feature, there is prepayment feature. So if there is prepayment, accordingly we'll do the recalculations. The company estimates what is given here. The contract specifies the borrower an option to prepay the instrument and has no penalty will be charged. The entity expects borrower not to prepay. So if there is no prepayment expected, as usual calculations, only when there is prepayment we'll do the calculations. If prepayment expected anengil, expected cash flows, so we'll take that prepayment also. Are you clear? If prepayment is expected, when we take the present value of expected cash inflows, we take the prepayment cash flows also. But prepayment is not expected. As usual, contractual cash flows will be discounted. No impact. Okay. So that's it. That will take care of this financial assets amortized cost. That takes care of financial asset amortized cost. Now fair value through other comprehensive income. Fair value through other comprehensive income. Okay. Fair value through OCI. So there are two types of OCI items. There are two OCI items. One is debt investments. Debt investments which is held till maturity, but also there is an intention to sell. Okay. And the other one is equity investments. All equity investments are by default. What did we say? All equity investments are by default FVTPL. But now we all are studying this. That is, entities are given an unconditional, irrevocable option by Ind AS 109 has given an unconditional, irrevocable option to designate the investments in equity shares as FVTOCI at the time of initial recognition. At the time of initial recognition, we are giving an option to entities. Investments in equity shares, you may categorize as FVTOCI or you may categorize as FVTPL. By default, FVTPL, you may designate it as FVTOCI. So that option is given to entities. If the entities are opting for it, it is irrevocable. You cannot go back to FVTPL, and it is unconditional. Whether 1% investments or 99% investments, either 1% investment in a company or 99% investment in a company can be designated as FVTOCI. Okay. So if it is equity investments, what are the journal entries? Investments in equity shares to bank. Investments in equity shares to bank. Fair value plus transaction cost. Investments in equity shares to bank. Oh, fair value plus transaction cost. Because both outflows, fair value plus transaction cost both outflows. So investments in equity shares to bank. At the reporting date, investments in equity shares should be reported at the fair value. So I acquired it at 100 rupees. And there is a transaction cost of 2. Initially, investments will be recorded at 102. Year-end market price is 180. Then that 78 will record investments in equity shares to fair value reserve in OCI. Fair value reserve in OCI. We'll record it as fair value reserve in OCI. Okay. And at the time of disposal of such investments, the cumulative gain or loss in OCI is reclassified too. I was telling you before in consolidation also, investments in equity shares can be recognized as FVTOCI. Reclassification is always to retained earnings. Okay. But any dividend or dividend income, other income received from equity investments, income will be to statement of P&L. But this fair value fluctuations will be to OCI, and OCI cannot be that reverse to at the time of disposal of investment. It cannot be reclassified to P&L. It will be reclassified to retained earnings. Yeah, these are okay. These points are all okay. Oh, shady. Now, what if it is debt investments? What if it is debt investments? Upon purchase of investment, FVTOCI, fair value plus transaction cost. Here, fair value is equal to market price. 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 Okay. So when you acquired investment to bank 102, recognizing income. For recognizing income, because it is debt investment, you have annual income to be received. If it is debt investment, you will be having annual income. So investment to interest at effective interest rate. Investment to income at effective interest rate, accrued interest, interest receivable. You should record it as investment to interest, investment to P&L. P&L, P&L. Income is always to P&L. Okay. Now, when you receive interest, actual interest received, bank to investment. Why bank to investment? Because income you have already debited to investments. Expected return you already debited to investment. Expected return you already debited to P&L. Investment to P&L. Investment to interest. Okay. So when you received actual, bank to investment. Now closing balance interest is in opening. Yes. Interest is in opening balance. Recognizing interest. They will try a question now. So investment to interest, opening balance. Now record investments at fair value. Record investments at fair value. That is closing balances 102 plus interest receivable, say 20. Actual interest received 15. Say for example, I'm taking random figures. 102 is the opening investment plus 20 receivable, but actual received is only 15. So 107 is the closing balance book value. Book value is 107. But closing balance as per the market is 120. Book value is 107. Closing market value is 120. Then what is the journal entry I should pass? Investments in debentures. Investments in debt instruments. Investment account debit to fair value reserve in OCI 13. Record investments at fair value and gain or loss will be transferred to fair value reserve in OCI. Yes or no? Fair value reserve in OCI. Okay. And if you sell that investment, any gain or loss in OCI will be reclassified to debt investments. Gain it will be reclassified to statement of P&L. Okay. Okay, FVTOCI. FVTOCI also, we had a question RTP, once we had a question MTP, but for exam till now they have not asked a proper question from FVTOCI. Okay, FVTOCI, maybe this attempt they will ask. So FVTOCI എന്ന question എടുക്ക്. Yes. Okay. Yes. So an Indian entity whose functional currency is rupees. An Indian entity whose functional currency is rupees purchased USD denominated bonds for $1,000. Okay. The bond carries stated interest at 4.7% on its face value. Okay. The interest is receivable at the year end. The bond has maturity period of 5 years and redeemable at face value of 1,250. So Indian entity whose functional currency is rupees purchased USD bonds for $1,000. Interest rate of bond is 4.7% on its face value. Interest is received at the year end. Bond has maturity period of 5 years and redeemable face value of $1,250. Okay. The bond is traded in the market at 1,060 at the end of the year. Exchange rates are given, average rate is given. The entity has determined that it is holding the investment with the objective of both holding the asset to contractual cash flows and also selling it. Ah. So from that information, I understood that this bond is to be categorized as FVT or OCI. The effective interest is 10%. EIR is 10%. What is EIR? IRR. My actual interest. If I invested, this is the face value of the bond, $1,250. If I invest, what are the inflows I expect? What are the final principal repayment? Actual rate is 4.7%. But me as an investor invested only $1,000 and I get this cash inflows. So my repayment, my interest, my income is 10%. മനസ്സിലായോ? For an investor who acquired bond at $1,250 and getting same inflows. And for an investor who acquired the bond at $1,000 and getting the same inflows, which means the second investor is getting 10% actual return than the contracted return. Contracted return is only 4.7%, but I got the bond at a lower price. So that itself is a profit and also further incomes. So altogether my income is 10%. മനസ്സിലായോ? That is what EIR, the rate at which present value of inflows and outflows tallies. Concept, is it okay? Now, so what are the entries here I need to pass if it is an FVTOCI instrument? So I used to tell you either the journal entries we need to pass. So here calculate how much gain or loss to be recognized in statement of P&L, statement of OCI and pass journal entries. So here straight away we'll do journal entries upon purchase of investments. Investment in bonds to bank. How much in class? First we'll do dollars, then we'll do rupees. Here together we are writing investment to bank. $1,000 into what is the date of purchase? 40. Rate on the date of purchase. So 40,000. Okay. Then first year end. Yeah, that's what. First year end. What is your EIR? You recognize interest at EIR. So investment to interest at EIR. Not 40,000 into 10%. Foreign currency, you should record $1,000 into 10% is the EIR and recognize at average rate. Very good. 42. So 420. 4,200. Average rate. So always keep an eye on this. So this is opening rate. Income should be always recorded at So I am explaining this with an assumption you all have done this, have seen this question before, all these areas before. നല്ലൊരു assumption ലല്ലേ നമ്മൾ revise ചെയ്ത് പോണേ. So I'm directly doing average rate, and if there is a doubt you will ask me why not on 40,000. If I apply on 40,000, then 40,000 into 10%, then I am not giving importance to my foreign currency fluctuations. Year end interest income is for a full year. So foreign currency effect also should be considered. So on $1,000, 10% into average rate. Yes. Now, now actual interest you received. What is the entry when you receive actual interest? Bank to investment. Bank to investment. How much is bank to investment? Bank to investment is bank to investment. You received actual interest. That is $1,250 into 4.7% is the actual interest, and you are receiving on which date? You are receiving on which date? You are receiving on year end date. So that is actual received is 45. 1250 into 4.7% into 45. And 2643.75. 31.3 in the 2643 point share in 2643.75 again. 2643.75 year end. For 31st March. 2643.75. Correct. 2643.75. Yes. So now I am calculating what is the book value of my investment. Book value of investment 40,000 plus 4,200 minus 2643.75, 41,556.25 is the book value of investment. What is the required closing balance? Required closing balance is, what is the closing market value of investment? $1,060 into closing exchange rate 45. 47,700. So 6,143.75 is to be increased. 6,143.75 is to be increased. Yes or no? Now I hope everybody is listening. Okay, everybody is listening. Is 6,143.75. What is the 6,143.75? You should say 6,143.75 includes fair value gain and also foreign exchange gain. There is fair value difference and also foreign exchange difference. Once more, things are not clear for me. That is $1,000. We bought it for $1,000. Now we recognized an interest of $100. $100. We recognized an interest of $100. Investment to interest $1,000 into 10%, $100. And we actually received in dollars. How much did you receive? 1250 into 4.7%. 7%. 58.75. So book value of dollars is 1,100 minus 58.75. Book value of dollars is $1,041.25. This has increased to 1,060. So there is a fair value gain of $18.75 is fair value gain. Fair value gain. Are you all understanding this? This is fair value gain. $18.75 is fair value gain. Are you all understanding, everyone? If there is a doubt, you will ask me, I'll repeat. Okay, so fair value gain should be transferred to OCI. So investment to fair value reserve in OCI. 18.75 into 45. 843.75 is fair value gain in OCI. 843.75 is fair value gain in OCI. And balance exchange gain. Balance exchange gain. What is this exchange gain? What do you mean by exchange gain? 5,300. Investment to P, exchange gain. Foreign exchange gain or P&L 5,300. How did you get? 6143.75 minus 843.75. That's it. Not just that. If I deeply get into this, 40 initially recorded at 40,000. So there is an increase of $1,000 into 40. So it has become $1,000 into 45 now. So there is a gain of 5,000. Plus interest you record at 42. $100 into 42. It has become 45. So $100 into 3 increased. These are the journal entries. So what is the question? Calculate gain to be recognized in P&L 5,300. Gain to be recognized in OCI 843.75. Past journal entries. Everything is done. Are you clear? If there is a doubt, you will ask me the doubt in the comment box. Clear. So not asked for exam till now. But in RTP, I think this is added also now. Practice. So എന്തെങ്കിലും doubts ചോദിക്കൂ. Others, if there is a doubt, you ask. In class, we have done with two amount columns, one for dollar and one for, we can do like that. Exam point of view, dollars is not required. Exam point of view, only rupees is required. ക്ലാസ്സിൽ അത് ചെയ്തത് നമുക്ക് കൂടുതലും മനസ്സിലാവാനാ. അതായത് ഡോളർ ആയിരുന്നെങ്കിൽ ഇങ്ങനെയായിരുന്നു. അപ്പോഴാണ് നമുക്ക് ആ ഒരു ഡിഫറൻസ് ഒക്കെ പെട്ടെന്ന് അങ്ങ് കിട്ടും. എക്സാമിന് അങ്ങനെ ചെയ്താലും കുഴപ്പമൊന്നുമില്ല. എക്സാമിന് അത് ചോദിച്ചിട്ടില്ല, ഡോളർ ചോദിച്ചിട്ടില്ല. കാരണം എൻട്രി നമ്മൾ എപ്പോഴും ഏതിലാ ചെയ്യുക? റുപ്പീസ് അല്ലേ. എൻട്രി യു നീഡ് ടു പാസ് ഓൺലി ഇൻ റുപ്പീസ്. So that is done because first time ഇതൊക്കെ കേൾക്കുമ്പോൾ പതുക്കെ ചെയ്തു പോണം. അതിനുവേണ്ടി അങ്ങനെ ചെയ്തു എന്നേ ഉള്ളൂ. Dollar and rupees, 2 columns. Examiner, that is not required at all. Only rupees column is needed. എല്ലാവരും okay ആണോ? Is it okay? I mean, എന്തെങ്കിലും doubts പറഞ്ഞു തരാനുണ്ടോ? So this was your ഒരു attempt. This came in MTP also, test papers also. That is this question number 24. So these are the 2 questions asked so far. So question number 24, on 1st April 2015, an entity purchases 10% 100 lakhs 5-year bonds with interest payable on 1st April each year. Focus should be on interest repayments at the end of each year. Actual interest is not at the end of each year. Actually, interest is at the beginning of each year. Okay, so on 1st April you purchase some bonds. Interest payable at the beginning of each year. Bonds purchase price. You bought this bonds at a higher price. You bought this bonds at a higher price. So what do you think conceptually EIR actual rate is 10%. Actual interest is 10%, but you bought at a higher price. So EIR will be less than 10% or EIR will be more than 10%? Of course, less than 10%. So they are telling the premium of 8,11,100 you paid more is due to market yield of similar bonds. The effective interest rate is 8%. EIR is 8% because you bought at a higher rate, so EIR is less. The entity classifies the bond as FVTOCI. Entity prepares its financial statements on 31st March. On 31st March 16, the yield on bonds with similar maturity and credit risk is year and again the interest rate has changed, but that interest rate I will not consider. Subsequent market fluctuations and interest rate will not consider. Our EIR, I invested at this amount and I will get this contractual rates. My EIR is 8%. Explain the accounting with the help of an year-end fair value is 1 crore 18 lakh 77,710. Explain accounting with the help of journal entries. Initial recognition and balance sheet date. What are the journal entries? What are the journal entries here? At the time of purchase, I'll pass the entry. Investment to bank. 1 crore 8,11,100. Okay. Then year end. Recognize interest. Investment to interest. How much is investment to interest? 1 crore 8,11,100 into 8% on the opening balance 8,64,888. Now I should not pass bank to investment entry. I should not pass because I'm not getting interest at the year end. I'll be getting interest at the beginning of next year. 1st April only I'll receive the interest. On the reporting date, I'm not getting interest. On the reporting date, I'm not getting interest. So last entry is book value 1 crore 8,11,100 plus 8,64,888. Book value is 1 crore 16,75,988. 1 crore 16,75,988. And what is the fair value? 1 crore 18,77,710. 2,01,722 should be transferred to. What is my third entry? Investment to Fair value reserve in OCI 2,01,722. Fair value reserve in OCI 2,01,722. This 2,01,722 investment to OCI. Investment to fair value reserve in OCI. എപ്പോ പറയത് ഓക്കെ ആണോന്ന്? ക്ലിയർ അല്ലേ? Now so that is FVTOCI. Okay, that is FVTOCI. Now FVTOCI. Now FVTPL. Fair value through P&L. Fair value through P&L. So as we said, fair value through P&L, only these investments in equity shares by default, held for trading investments, derivatives. Okay. So investments are initially recorded at, if it is FVTPL, investments are initially recorded at fair value plus transaction cost is not there. Transaction cost is transferred to P&L. Because you don't capitalize, it is held for trading. So don't capitalize to the value of asset. It will be immediately sold, so transfer to P&L. Any income or expense from investments to P&L. Fair value gains and losses to P&L. Oh, very easy. Yes, ശരിക്കും. Seriously, it is very easy. So transaction cost we will summarize as, if it is financial asset, add to financial asset if amortized cost at FVTOCI. Okay. Transaction cost is added to financial asset if it is amortized cost and FVTOCI. If FVTPL, transfer to statement of P&L. Transfer to statement of P&L. Financial liability, yeah, we have not discussed. Deduct. Compound financial instrument, deduct, allocate in the ratio of respective fair value. Deduct. But we have not come to that. Okay. So that takes care of our first area, that is financial assets. So financial assets are divided into three categories: amortized cost, FVT, OCI, FVT, P&L. Amortized cost, FVT, OCI, FVT, P&L. Okay. Is it clear? Yes. Now financial liabilities. Financial liabilities. Liabilities again ഒരു 5 minutes break കഴിഞ്ഞിട്ട് പറയാം അല്ലേ? 90. നമുക്കൊരു 25, 12:25 ഒക്കെ ആകുമ്പോൾ we'll discuss. ഒന്ന് എഴുന്നേറ്റ് നടന്നിട്ടൊക്കെ വരും. We'll just walk and come back. Financial liabilities. Okay. Financial liabilities. Financial liabilities. There was a network issue here. So അത് ചെക്ക് ചെയ്യാൻ ഒരാൾ വന്നേക്കായിരുന്നു. അപ്പൊ എനിക്ക് പെട്ടെന്ന് ഞാൻ പെട്ടെന്ന് അങ്ങ് ബ്രേക്ക് തന്നത്. സമയം കഴിഞ്ഞു പോയി. It's okay. So it's financial liabilities. Financial liabilities, for the purpose of accounting, financial liabilities are divided into two. Financial liabilities are of two categories. Again, at the time of initial recognition itself, we'll identify the types of financial liabilities. So amortized cost and FVTPL. And what is amortized cost? By default, all liabilities will fall under this category, because there is a fixed repayment due date. If you have a liability, it's an obligation, contractual obligation. So there is fixed due dates and there is fixed payments to be made, contractual payments to be made. So it is amortized cost category. Now, there is also a category FVTPL. This FVTPL is for all derivatives for financial guarantee, because there is no contractual, your payment will fluctuate. There is no contractual outflows. And sometimes if you've taken a loan, and I've taken a loan for say for example 3 years, but if the entity is sure that it will be repaid in 6 months, then you can measure the loan at FVTPL. The loan will be recognized bank to loan. If you have taken loan at 5 lakhs, loan amount is 5 lakhs, then it will be repaid in 6 months. So I have to repay 5,80,000. So loan account debit 5 lakhs, P&L or finance cost 80,000 to bank. So to avoid accounting mismatch, the management may categorize it as FVTPL. Otherwise, all liabilities, all financial liabilities will be categorized as amortized cost. To avoid accounting mismatch, you may categorize a liability as FVTPL, and all derivative liabilities and financial guarantee are also FVTPL instruments. Okay, fine. Now, compound financial instruments. Compound financial instruments are those instruments having characteristics of both equity and liability. Characteristics of both equity and liability. Rule is to recognize like share-based payments, combination plan. Rule is to recognize maximum liability and minimum equity. Rule is to recognize maximum liability and minimum equity. And how, if in case of a compound financial instruments, how do I calculate the liability? Liability is, sorry, liability is present value of cash outflows. Yeah, correct, outflows. Outflows discounted at market interest rate. Asset is present value of cash inflows discounted at market rate. Here present value of outflows discounted at market rate. Okay. And equity is equal to issue proceeds minus fair value of liability. Okay. Now just a table, as we have already written: loan to employees, prepaid employee cost; security deposit, prepaid lease expense; investment in subsidiary, prepaid business expense. We have just seen this before. Same, if compound financial instruments, we'll record liability. So issue proceeds minus liability is equity. Loan from holding company. If I am a subsidiary and I got loan from holding company, then fair value, discounted value is the fair value. Difference will be recorded as capital contribution from parent. Loan from an unrelated company, prepaid business income. Okay. If it is liability. Sharing. So, liability. Let's try a question. So, liability, we are going to try this question. Sorry, number, 1 second. Let me quickly take it. So, this question has asked answer ഉണ്ട്. അപ്പോൾ we'll take this question number 16. This came in November 2018. For 8 marks, and May 22 for 14. 8 marks അല്ലേ? just to discuss the journal entries and just to discuss that final settlement entry, we'll take this question number 16 in our book. A Limited issues 1 crore convertible bonds on 1st July 2011. Okay, 1 crore convertible bonds. Bond has a life of 8 years and face value of rupees 10 each. They offer interest payable at the end of each financial year. They offer interest payable at the end of each financial year at a rate of 6% per annum. The bonds are issued at their face value and each bond can be converted into one ordinary share in A Limited at any time in the next 8 years. Companies of a similar risk terms have recently issued debt with similar terms without option for conversion at 8% per annum. So what is this 8% per annum? So what are the contents here? 1 crore is the amount of bonds we are issuing. 1 crore amount of bond issued, 1 crore. Life 8 years. Actual rate of interest is 6% per annum. Bonds can be converted into ordinary shares until next 8 years. Companies of similar risk terms have recently issued debt with similar terms without option for conversion is 8%. If it was a non-convertible bond, the rate of interest is 8%. So what are the calculation? Provide the accounting entries for initial recognition. So what are the calculations here? So examine if I get this, I'll quickly 1 crore into 6%. So how much is my interest? 6 lakhs. For how many years? 8 years. And 6 lakhs into annuity factor at 8% for 8 years. Yes or no? 8% for 8 years. 1, 2, 3, 4, 5, 6, 7, 8. 5.746. 5.746. That's the factors we have taken. 7466. 6 lakhs into 5.7466. 34 lakh 47,960. Then 6 lakhs you need to repay after 8 years if there is cash outflow, not compulsory convertible. Therefore, 5.40, 1 divided by 1.08. 1, 2, 3, 4, 5, 6, 7, 8. 0.5402. 5403. 3,24,180. So it is 37,72,080. What is this 37,72,080? $88 lakhs ആണല്ലേ 1 crore അല്ലേ 6 lakhs അല്ലല്ലോ 100 lakhs into 0.54. This is 54. 54 lakh 3,000. 147. It is 88 lakh 509. So 88 lakh 50,960 is the present value of liability or fair value of liability. So equity is 100 lakhs minus 88 lakh 50,960. This is the equity. Easy. Easy. Correct. Yes. So initially we identified how much is equity, how much is liability. Now first year entry. Bank account debit, convertible bonds liability, convertible bonds equity, or bonds liability portion, bonds equity portion. Okay, that I have done. Then this is my step number 1. Then what is your step number 2? Is it journal entries your step number 2? Step number 2 in exam, what you should do is you should prepare amortization table. Amortization table for this 88,50,960, which we are not doing. Why you are not doing? Because അറിയാലോ amortization table. Why do we need to do this now? So 88,50,960 unwind at 8%. അല്ലേ? 88,50,960 interest unwinding. 88,50,960 into 8%, 7,08,077. First year repayment 6 lakhs. So closing balance 8. So interest expense 89,59,37. Then increased. So interest to liability, liability to bank. Interest 7,08,077 to bank 6 lakhs. So balance to convertible bonds. Repeat the journal entry. Repeat the entry for 8 years. Oh, 8 years should I do? Allah, requirement നോക്കിയിട്ട്. So first I pass the accounting entries at the initial recognition. Then they are asking what is the stream of interest expense. For this I am preparing the amortization table. Provide the accounting entries if the holder of the bond elect to convert the bonds to ordinary shares at the end of 3rd year. What if they plan to convert this at the end of 3rd year? 3rd year if they convert, what will be the journal entry? 3rd year. Okay, 3rd year. This is my amortization table. So 3rd year opening, 1st year and 2nd year and 3rd year. 3rd year and they convert it into equity shares. What will be the journal entry? So 3rd year closing balance is 92,01,821. 92,01,821. So I'll pass the entry convertible liability account debit 92,01,821. There is a convertible equity account debit. How much is the balance in convertible equity? 11,49,040. 11,49,040. 2. Equity share capital with the face value and balance to securities premium. But in this question, they have not given the face value of equity shares issued. How many equity shares and what is the face value of equity shares is not mentioned in the question. Face value is not mentioned in the question. So this type of questions are study material questions only. So I used to say in class, see, we can easily assume face value is 1 crore or face value is 10, per share is 10 or total face value is 1 crore. You can easily assume. But here see here what they are doing is in the study material and in the suggested answers, what they do is convertible liability, convertible equity, full amount to share capital without assuming the face value. So exam also I used to say you just go for this assumption. I mean like entire balance is transferred to share capital when the face value is not given. Rather than writing share capital to securities premium, full amount can be transferred to share capital. Okay. Okay. Yes. And this question number 17 also with EIR question. Question number 17 EIR CCCPS question. Oh, this question is also asked in May 2019 for 12 marks. And now in November 23 for 14 marks. Okay, so if let's finish this and then move on to derivatives. So here, so always if it is financial liability, amortized cost, accounting is more or less similar to accounting for asset, just reverse way. That's it. But we'll try this question and then move on. ABC company issued 10,000 compulsory cumulative convertible preference shares. ABC company issued 10,000 compulsory cumulative convertible preference shares as on 1st April 2011 at rupees 150 each. The rate of dividend is 10% payable every year. Rate of dividend is 10% payable every year. The preference shares are convertible into 5,000 equity shares at the end of 5th year. Okay, the preference shares are convertible into 5,000 equity shares at the end of 5th year from the date of allotment. When CCCPS are issued, prevailing market interest rate for similar debt without conversion option is 15% and transaction date on the date of issue is 2%. So what is this? We have issued 10,000 compulsory cumulative preference shares at rupees 150. The preference shares are convertible into 5,000 equity shares at the end of 5th year, and 15% is the market rate of interest and 2% is the transaction cost. Date of allotment, date of conversion, number of preference shares, face value of preference shares, total proceeds, rate of dividend, market rate, transaction cost, face value of equity shares. So here you don't have an option. To share capital at the time of conversion will be definitely 50,000 and excess will be to premium. Yes or no? Yes. Effective interest rate is 15.86%. You are required to compute the liability and equity component and pass journal entries for the entire term of arrangement from issue of preference shares till the conversion. Okay. We will do. Sharing. How are you going to try this? So, first step is fair value of liability. Exam will write as per Ind AS 109 when there is a compound financial instrument that is convertible preference shares, it should be divided into equity and liability. Line then we'll write fair value of liability is equal to what are the interest payments. 10,000 preference shares, 150 means 15 lakhs. Yeah, 15 lakhs. What is the rate of dividend? Payable every year, 10%. So, interest is or 1,50,000 into annuity factor at market rate of interest 15%. Should I adjust 15.86%? Should I consider? No. Fair value is 15% for how many years? 5 years. 1, 2, 3. 1, 2, 3, 4, 5. 3.3521. 3.3521. 5,02,815. Do you think we need to take this 15 lakhs outflow? Look, can I take this? For computing fair value of liability, is this enough or should I take principal? Yeah, compulsory convertible. This is compulsory convertible. There is no outflow. Don't take it. Compulsory convertible, no outflow. Don't. Correct. So, balance equity. Okay, fine. So, 5,02,823 answer. Here it is PV factor up to 6 decimals. So, we have taken only 4. So, the 23 rupees, 7 rupees difference is there. It's okay. So, 5,02,815. minus 15 lakhs. Equity is 9,97,185. Okay, this is my step number 1. Examine if this repeats. This is my step number 1. Okay, then what is your step number 2? Amortization table. No. Adjusting transaction cost. Adjusting transaction cost. What adjusting transaction cost? What do you mean by adjusting transaction cost? Being a compound financial instrument. Being a compound financial instrument, transaction cost of 30,000 should be adjusted to equity and liability. They are in the ratio of liability and equity. Exactly. In the ratio of equity and liability, this is to be adjusted. Once more, yeah, that is liability is 5 lakh to 815. Equity is 9 lakh 97 185. So total 15 lakhs. So transaction cost is to be adjusted against that 15 lakhs. So total will be 14 lakh 70,000. Okay. So how much should be adjusted against this? How much should be adjusted against this? 30,000 into 5 lakh to 815 divided by 15 lakhs. 10,056. 19,944. 10,056. Yes. Okay. Hmm? Now this liability will be, for this liability we will prepare, amortization table. For this liability we prepare amortization table, and in the amortization table, which rate is to be used for unwinding? EIR 15.86%. Which rate is used for unwinding? 15.86% should be used for unwinding. Assume effective interest rate. Assume, let's given interest rate. So we'll take 4,92,767. Interest unwinding, repayment, closing balance, unwinding, repayment, closing balance, unwinding, repayment, closing balance, unwinding, repayment, closing balance, unwinding, repayment. Last year nil, because there is only in 5 years interest payments or dividend payments. With that, the closing balance should be nil. Okay. So past journal entry. First step, fair value of liability. Come on, listen. First step, fair value of liability. Okay. Then transaction cost adjusted. Okay. Then third, prepare amortization table. And in the amortization table, interest rate should be EIR. Then journal entries. What are the journal entries? Journal entries, I hope that is okay. Bank account debit to preference shares to equity. Preference shares liability and equity component of preference shares. Preference shares liability and equity. Okay. Now repayment. First you should do interest to liability liability to bank. In the study material answers or suggested answers, that order can change. Finance cost to preference shares. Okay, interest to preference share liability to bank. Then second year, interest to preference share liability to bank. Third year, interest to preference share liability to bank. Then interest to preference share liability to bank. Finally, so liability account is fully closed. Then there is an equity balance of 9,77,233. And what should be the final journal entry? Final journal entry should be preference shares equity to equity share capital to securities premium. Are you okay? To securities premium. Great. Now, so if the question says, if the question says convertible debenture or bond or preference shares, then fair value is equal to interest payments plus principal outflow. This will be discounted. Yeah. Okay. Any. No information. No information means, yeah, if convertible debenture, bond or preference share, question says convertible to the extent of 60%. Then fair value is equal to interest payments plus principal 40% outflow. Oh, you will take principal only to the extent of, because convertible to the extent of 60% means there won't be any cash outflow. Yes or no? 3. Compulsory convertible. Fair value is equal to interest payments only. Is that okay? All okay? Hopefully, yes. Now, liability P P&L. P&L we don't do. Liability, FVTPL will do. There are only two FVTPL instruments, that is derivatives and financial guarantee. Both we will do. Both we will do separately. So here we have done only this. Financial assets, financial liabilities, types and accounting. There are two types. And accounting of amortized cost alone. Compound financial instruments. Now derivatives. Derivatives, see, the derivatives accounting is very easy. But the problem is, if we don't pay attention to it, the question is different or difficult to understand. Question, it takes some time to understand. Once the question is clear, the answer is very simple. But to understand the question, it takes time. Okay, but it is not going to be an issue for you. Derivative accounting. We are getting into derivative accounting. So derivatives. So here once more, transaction cost, if it is financial asset, added. If it is financial liabilities, if there is a transaction cost, loan, if there is a transaction cost, deduct. If there is a loan, transaction cost will be deducted. Now, if it is compound financial instrument, allocate in the ratio of relative fair values. Allocate in the ratio of relative fair values. Okay. In all the case, if it is FVTPL, transaction cost is always transferred to P&L. Okay. Now, derivatives. Derivatives. First, I may have to write this November 24. We got, so far derivatives have been asked in May 18 and November 24. Both attempts we got the same question. Both attempts we got almost the same question. So derivatives. What are derivatives? Derivatives are contracts having three features. In both the exams, they ask what are the features of derivatives. So you need to write the theory. Derivatives are contracts having below three features. Value changes with the value of underlying. Okay. Settlement is on a future date. Okay. Then no or very low initial investment. No initial investment or very low initial investment. No or very low initial investment. And there are four types of derivatives: swaps, options, forwards and futures. Okay, fine. Now derivatives accounting, derivatives are FVTPL instruments. Always fair value gain or loss will be transferred to P&L. There is no entry, generally no entry upon initial recognition. Any income received during the contract period is transferred to statement of P&L and determine fair value of derivative asset or liability at the end of each reporting period, and gain or loss is transferred to P&L. Okay. So what are the accounting treatments of derivatives? Derivatives are very easy, but we need to understand some points. So first, let me read this. Read that November 24 question. But before November 24 question also, I want to discuss one point. This is November 24 paper. May 24, November 24. Bah, done. Question number 2A. So what I need to understand is some points. Listen. On 1st January 2023, this is November 24, question number 2A. On 1st January 2023, Joe and Company Limited, an Indian listed company which prepares its financial statements on quarterly basis, has entered into a return put option for US dollar $40,000. What is this put option? By this time, you all know what is put option. Put option, you should say put option gives the holder the right to sell. So what about writer? Put option to sell. The put option, right to sell. Holder the right to sell. You should say put option gives the holder the right to sell. Put option gives the holder the right to sell. Okay. Put option gives the writer obligation to buy. If you are the writer of a put option, you have the obligation to buy. You have the obligation to buy. Okay. So here, there is an entity has entered into a written put option means what? What do you mean by written? Put option, you are the writer. Written put option means you have written. I've written a put option. I'm holding a put option. I'm written a put option. What is the meaning? Holding means holder. Written put option means writer. Writer obligation to buy. Other question they will not mention. Written put option, they are like, oh, the students will understand this. Written put option, the students will understand. Okay. Written put option for US dollar $40,000 with Box Limited to be settled in future on 31st December 2023. So you are entering into the contract on which date? You are entering into the contract on 1st Jan 23. Okay, and this will be settled in 31st December at a rate equal to 78 per US dollar, which means you have entered into the contract. First, I need to understand me, that is Joe and Company, has entered into the contract to buy dollars at rupees 78. That I need to understand. Is that clear up to this? Now, okay. And we have not received any amount upon entering into the contract. Fine. Now, for the purpose of accounting, use the following information representing mark-to-market fair value of put option contract as at 31st March 23. First year ending date, reporting date, 31st March 23. Fair value of the forward is minus 50,000. You know what is the meaning of minus 50,000? Fair value loss. Oh, when you already entered into a contract to buy dollars at rupees 78, then when it will be a loss? When the dollar rate increases or dollar rate decreases? When it will be a loss? When it becomes a loss, dollar rate decreases. Dollar rate decreases. Decreases. Because I already entered into a contract to buy at 78. If it becomes 79 or if it becomes 80, I'm happy because still I need to pay only 78. But here it is, if it becomes 76, I'll feel very bad because I already entered into a contract to buy at 78. Yeah, correct. So fair value loss. What is the journal entry when there is fair value loss? On this reporting date, what is the entry? Reporting date entry is P&L to derivative liability. That contract has become a liability for me. P&L to derivative liability. Okay. Yeah. Derivative financial liability or derivative liability. On 30th June, the fair value loss has become 30,000. What is my entry? I already recognized 50,000 liability, but now my liability is only 30. Fair value, today's fair value is only 30. So what will be the journal entry? Derivative liability to P&L 20,000. Okay. At 30th September, things are favorable for you. Conditions are favorable. Initially, conditions were unfavorable, but now favorable. Nil, gain or loss nil. So what you should do? Derivative liability to P&L. Reverse entire 30,000. Finally, my date arrived and it is 76. Evaluate and explain whether the above option meets the definition of derivative. So write the definition of derivative. Derivative are contracts where value changes with the value of underlying. A derivative can be considered as derivative if value changes with the value of underlying. There is no settlement initial, no or very low initial settlement. Settlement is on a future date. If all the three satisfied, it is a derivative. Hence, this is a derivative contract. Okay. And record the entries till the actual purchase of US dollar. When you actually purchased US dollar, what is the journal entry to be passed? What is the last entry to be passed? My last entry is, if I do it as a single entry, my journal entry will be, I am purchasing US dollars here. So my entry will be last date 76. Is it gain or loss? Loss. Loss. So US dollar. How much is the US dollar I am buying? How many? $40,000 into 76. US dollar value is 40,000 into 76. 30 lakh 40,000. To bank, how much did you pay for this? 40,000 into 78. 31 lakh 20,000. Is there a derivative asset or liability recorded? No, everything was reversed. Nothing. So there is a loss. P&L 80,000. മനസ്സിലായോ? ഓക്കെ അല്ലേ? എളുപ്പമല്ലേ ഇത്? This is easy. ഞാൻ പറഞ്ഞ question. Maybe some students are not understanding the question properly. Return put option. This time the problem was return put option. When May 2018 they asked the question, one entity and contract. May 2018 they were very specific and mentioning the contract was to purchase 40,000 US dollar. But this time they made return put option. But we are final students. We should expect this kind of questions and not straightforward, making us ഒരു എന്താ പറയുക comfortable kind of questions അല്ല expect ചെയ്യേണ്ടത്. This is what we should expect. And ഇതൊന്നും ഒന്നുമല്ല. This is very easy. So swaps, examiner swap kind of questions വന്നിട്ടില്ല, but we have tried one or two question swap, but always swap forward futures. Forward contracts are, we always say, if it is a forward contract, we can decide what are the terms. If it is future contract, we are directly buying from the market. Directly buying from the market and trading. That is future contract. So whatever is the contract, whatever the contract is, now this, we'll just go through this and uh, stop. Embedded derivatives. What are embedded derivatives? Embedded derivatives are prima facie a purchase contract, prima facie a sale contract, prima facie an equity liability, some other contract, but in that a loan contract, liability, but in that there is a derivative feature. This is some other contract, prima facie a host contract. There is a host contract, primary contract or host contract. This is a liability purchase sale contract. In that there is a derivative element. So if host, there is a derivative element. So in the main contract there is a derivative element, and this is not a derivative contract but derivative feature is there. So we call it as embedded derivatives are, we used to say in class, it is stitched in derivatives. Stitched in derivatives. Hidden derivatives. Primarily it is not there, we have stitched in, or there is a hidden derivative element. So what you should do? So the standard says, I am reading what is given in 109. If host contract is a financial asset, in an asset contract, it is an asset for you and there is a derivative element, no need to be careful, no need to separate. No need to separate. But if your host contract is other than financial asset, separation is required if all the three conditions are satisfied. If all the three conditions are satisfied, if all the three conditions, you should take that effort to study. Effort edutanga padichodnam. What is that? If three conditions are, because if you get a question on embedded derivative, we got embedded derivative question in May 24, question number 2A. We got derivative in November 24, question number 2A. So in May 25, question number 2A, mostly, because question number 1 will be consolidation or business combination, question number 2 will be financial instruments, maybe, because for last our old syllabus, for that May 18 to November 24, November 24 alla, May 18 to November 23, mostly question number 4A was financial instrument plus additional questions. Appo ivide additional questions also will be there. I'm just telling, എന്തിനോ വേണ്ടി പറഞ്ഞു. അപ്പോൾ embedded derivative are stitched in derivatives or hidden derivatives. So embedded derivatives require separation. If embedded derivative is a derivative in other than financial asset, separation is required if three conditions are satisfied. So what I'm trying to say is May 24, they're asking you whether there is a derivative, separation is required, where maybe they will ask me to write these 3 points. So what are the 3 points? The economic characteristics. Economic characteristics means risk and return. I'm studying economic characteristics, risk and return of host contract and derivative contracts are not clearly or not closely interrelated, separate if the risk and return of derivative and risk and return of host is not closely interrelated, means risk of these are closely, highly interrelated, not related at all, then you split, separate. Derivative, if I separate, it should have all the three features of an independent derivative. Value changes with the value of underlying, no or low initial investment settlement on a future date. It should have all the three features of an independent derivative. Okay. Now, the hybrid contract is not accounted as FVTPL. Hybrid means that together, that single contract, derivative plus host contract is not accounted as FVTPL. If it is accounted as FVTPL, then no need to separate because host is FVTPL. Derivative is also FVTPL. Then together you account it as FVTPL. What's wrong? Nothing wrong. But cost is amortized cost. Derivative is FVTPL. Then you should separate an account. Okay. Fine. Understood. Now there are mm, uh, derivative elements. We do like this: if financial liability or equity. If financial liability or equity, if derivative, if host contract is liability or equity. In our study material, no guidance is given, not covered in our syllabus. For purchase or sale of non-financial assets, yeah, this is what given importance to. This is given in a detailed way. This is what asked in May 2024. Then prepayment option and debt instrument. This is also given and we'll try this problem. These two areas are there. Okay. So just ഈ question ഒന്ന് just ഒന്ന് കണ്ടിട്ട് we'll just see and leave. This is in our old syllabus RTP question. One question came in RTP. By reading this, we'll stop. Okay. Certain callable convertible debentures are issued at rupees 60. Callable convertible debentures. Callable convert. This is a question. We'll stop now. Callable convertible debenture, which means a debenture with a call option, that is a derivative option, and a convertible option, equity option. Callable convertible debenture is issued at rupees 60. Fair value of similar debentures without call or equity is 57. Pure liability value is 57. Value of call determined under your favorite Black and Scholes model is 2. Okay. Okay. So determine the value of equity and liability. So you need to study this. I hope this is a good question for conceptual clarity. That is callable convertible debentures. To understand the concept, callable convertible debenture means a debenture is a liability. Liability with equity option means equity option increases the demand of the debentures. Equity conversion, I am buying something, but there is a equity conversion option means that increases the demand, increases the value of the debentures. But there is a call option. Call option always decreases the value of debentures. Why call option decreases the value of debentures? Call option decreases the value of debentures. Why? Because this is the company and this is the debenture holder. Debentures issued to this debenture holder. So debenture is with which party? Debentures are in the hands of debenture holder. Debentures are in the hands of debenture holder. So call option means what? Call option means which gives the holder the right to buy. Can debenture holder be the holder of this call option? Can debenture holder be the holder of this call option? Can debenture holder become the holder of call option? No. So if callable convertible debenture means call option holder is company. Call option holder is the company. So which means any time debenture can be called back. So if debentures call option holder exercises the option, you have the obligation. So value of liability plus value of equity minus value of call option. So here 60 is equal to liability plus equity minus this is the value of call. Therefore equity liability is 57, equity is 5 and call is 2. Similarly, puttable debenture means value of liability plus value of equity plus value of put option, because put option increases. At any time I can sell also at a value. Put option increases the value of debentures. So if at all you get an MCQ or anywhere any calculation, this is the step. So that's it. We'll continue tomorrow. We'll continue tomorrow means tomorrow, as per my schedule, we have only 2 hours, but I'll take till 1 o'clock maybe. To make up. We'll take up to 1 o'clock and close. Tomorrow we'll close this financial instruments. All the practice, all the other questions we'll try. Okay, so take care. Try all the questions. That's it. Bye. Thank you. Good morning, everyone. Shall we start? Yes. Okay. Now listen. Yes. Good morning. So we are starting. We started with derivatives. So what are derivatives? Derivatives are contracts. You have entered into a derivative contract. You consciously signed a contract where the value, there is an underlying in that. The value changes with the value of that underlying. The contract value changes with the value of underlying. So that is yesterday we tried a question where there is a contract to purchase. So what is a derivative contract? A contract to purchase or sell or settle uh, based on the underlying value, based on the value of the underlying. That is why the value fluctuate with the value of underlying. Yes, it can be a foreign currency, it can be a financial asset, it can be anything. Okay, but commodities are not covered in the standard. Like I'll come, that is, this is financial instrument. So it is purchase or sale of a non-financial asset settled on a gross basis is not covered by the standard. That I'll come to that. For time being, we are doing derivatives. Okay, in that derivatives, we started with embedded derivatives. Embedded derivative means in a derivative contract, there is sorry, embedded derivative means in a some other contract there is a derivative feature. Some other contract in that there is a derivative feature. I didn't understand what it is. So we were saying financial liability or equity, there is no guidance given. But yesterday last we tried a callable convertible debenture, puttable convertible debenture. How do you split? That includes derivative element also. So how do we split? Yeah, that we have discussed yesterday. Now coming to purchase or sale of a non-financial asset. Purchase or sale of a non-financial asset is not covered in the standard. Purchase or sale of a non-financial asset is not covered in the standard, but that settlement is in foreign currency. The settlement of that non-financial asset is denominated in foreign currency. Settlement is denominated in foreign currency. So how you should do? How you should account that such transaction? Once more, that is a contract you entered into. This is a contract. The contract entered into on, say, for example, 1st January 2025, you entered into a contract to purchase a non-financial asset, a PPE or a commodity, whatever, on 31st December 2025. The settlement you have agreed to make in $1 lakh. So generally, what is the date of our journal entry? Generally, we'll pass the journal entry on which date? If it is non-Ind AS, the journal entry will be passed on this date, 31st December 2025, when we receive the asset and we make the settlement. The journal entry will be passed on this date. But what the standard says is that on this date you entered into the contract. So on this date, on 1st January 2025, you entered into the contract. Correct. On 1st January 2025, we entered into the contract. You entered into the contract to purchase or sell something, and you also promised to pay $1 lakh. Yes. And this dollar rate fluctuates. Being an Indian company, being Indian rupee your functional currency, for example, if $1 lakh is what you're settling, the dollar rate keeps changing during this contract period. So this contract includes a derivative element. It is not just a purchase contract. If the purchase is at rupees 1 lakh, is there a derivative element? Rupees 1 lakh, then there is no derivative element. The derivative element is you promise to pay $1 lakh, and the dollar rate keeps fluctuating. So this includes a derivative element, because finally when I settle, the settlement can be at a higher value, at a lower value, not based on the value of asset, based on the dollar rate. So there is a derivative element. So one last time, we entered into a contract. To purchase something or to sell something. The contract date is 1st January 2025 and settlement is after 12 months. And your functional currency, in my example I am telling, your functional currency is rupees. Your functional currency is rupees, and the contract is entered in dollars. So what we are trying to say, during that contract period, the dollar rate fluctuates. So your final settlement value will change according to the fluctuations of the dollar rate. So even though prima facie this is a what contract? Prima facie this is a purchase contract. Prima facie this is a purchase contract, but settlement is in $1 lakh. So there is derivative element which requires separation. So how do we separate? That is what we are going to discuss. How do we separate? Shall we quickly take that? As I told you, we got a May 2024. We got a question from the study material only. So we'll take that question and we'll try question number. What question we'll try? May 2025. Two. May 2025, question number 2A. May 2024, question number 2A. Yes. Quickly. Dark Limited is engaged in the construction and operation of a thermal power plant in the country. Okay, one company is engaged in the construction and operation of a thermal power plant in the country. It has entered into a purchase contract for $2 lakh with Bright Limited. Dark one.
Urdu.
Okay, so listen. Dark Limited is engaged in the construction and operation of thermal power plants in the country. It has entered into a purchase contract for $2 lakh with Bright Limited on 1st October 2023 for purchase of power plant equipment on 31st March 24. It is pertinent to note that the functional currency of both companies is INR. Dark and Bright are listed companies in India and prepare their financial statements on a quarterly basis as per Ind AS. So they are specifically mentioning that INR is their functional currency and dollar is their foreign currency. The contract is entered into in foreign currency and prepare their financial statements on a quarterly basis as per Ind AS. Spot rate 75, that is on the date of contract. The rate on 31st December is 82. 3-month forward rate is 70. 6 months forward rate is 80. And spot rate on 31st March 2025 per US dollar is 85. What are the rates given? See, what is my contract date? Contract date is 1st October. On 1st October, when I signed the contract, the exchange rate is 75. Okay. Then spot rate on 31st December 2023. Finally, on 31st December 2023, not finally, 31st March is my settlement date. 31st December is 82. Okay. 3-month forward rate. From this date, 3-month forward rate is 70. 6 months forward rate is 80. And spot rate on 31st March is 85. So you have studied this before. Can you tell me which rate is more relevant here? Is it 75, 80, 82, 85, 70? Okay. Which rate is more important? The most important rate is 80. 80. Not 75 is not important. 80 is what important. What important? I don't understand. So here, what the question is, assume this contract has embedded derivative that is not closely related and requires separation. You are required to pass necessary journal entries in the books of Bright Limited from the inception of the contract till the actual sale of equipment. So here, what are the journal entries required? Shall we try this? What are the journal entries required? Shall we try this? Yes, notebook il cheyanata. You should try this. So what are the steps to be done? Okay, so this is May 24. Question number 2A. So what is to be done? So first examine when I write as per Ind AS 109, the embedded derivative in a purchase or sale contract. In a purchase or sale contract, which is denominated in foreign currency, requires separation. Okay, which requires embedded derivative in a purchase or sale contract which is denominated in foreign currency requires separation. The contract is separated as below. Contract is separated as below. The contract is separated as below. How this contract is separated as below? Brackets in the books of which company? There are two companies, Dark and Bright. They are asking in the books of Bright Limited. I used to say always read that requirement first. Always read the requirement first. Requirement you should read first. Initially, they are giving the information from the point of view of Dark Limited. But finally, they are asking the journal entries in the books of Bright. So, journal entries or accounting in the books of Bright is what we are giving. Contract is separated as below in the books of Bright Limited. Bright Limited's point of view, sale of equipment is at sale of equipment is at $2 lakh. But the moment this Bright Limited is signing the contract, or Dark Limited, both parties signing the contract, we have entered into the contract to sell the equipment at $2 lakh. But what is your anticipation? What is your expectation? $2 lakh into how much you are expecting to receive? 2 lakhs into $2 lakh into 80 is your expectation. So 2 lakh into 80, 160 lakhs. Sale of equipment should be recorded at whatever fluctuations happen. Sale of equipment should be recorded at 160 lakhs. That is, sales should be recorded at 160 lakhs. Dollar rate, whatever fluctuations happen, your sale should be logged at 160 lakhs. Why 160? Are you all clear? Everybody clear why it is 160 lakhs? Is there anyone feeling once more? Can you explain like that? That is the moment when I signed the contract, I am sure that $1 is equal to 80. That is what I am supposed to receive after 6 months. That is my anticipation. Where it is given spot rate, today's rate is 75. This is not my expectation. I'll be, are you 6 months forward contract? After 6 months, $1 is equal to 80. That is my anticipation. Yeah, okay, 80. Now, forward contract. Now I'm thinking or asking myself, when I sell the equipment, will I get foreign currency or will I have to pay foreign currency? Forward contract, because this is we are splitting one contract into two. Sale, at the time of sale, I'll receive 160 lakhs cash, and there is a forward contract. Will I receive foreign currency or will I have to pay foreign currency? Receive. So here forward contract to receive. Brackets le buy. It's not hedging. Don't think if I have to receive, when I receive, I need to sell. Anganella, that is hedging. Here forward contract to receive foreign currency, $2 lakh at rupees 80. In this, I am also entering into a forward contract to receive or buy $2 lakh at rupees 80. To buy $2 lakh at rupees 80. Forward contract to buy. Either in an embedded derivative, I have to think here what is happening. In this contract, there is an outflow of asset, 160 lakhs worth of asset. There's an inflow of dollars, $2 lakh. Okay, so this $2 lakh inflow is there. So contract to, in this contract, I am contracting to sell an asset and contracting to get $2 lakh. E-contract, there is a contract to receive $2 lakh. That is receiving, I am recording it as buy. I am agreeing to buy dollars at rupees 80. Okay. Now, journal entries. What are the journal entries? What are the journal entries? There is a derivative contract. What are the journal entries? Journal entries on 1st October 2023. No entry. Why no entry? On 1st October 2023, no entry. Why no entry? Am I audible or am I stuck? Yes. Yes means audible. No initial entry for derivatives. No initial entry for no entry upon initial recognition. Why no entry upon initial recognition? Because there is, see, what is this fair value of derivative? What is your expected gain? What is your expected loss? There is no expected gain or loss on the date of contract. On the date of contract, I don't have any expectation. Subsequently, as the time passes, each reporting date. So next reporting date is 31st December 23. 31st December 23 is my next reporting date. 31st December 23, two rates are given. 2023's dollar rate is 82. 31st December's anticipated rate for 31st March 24 is 70. Which rate I should consider? 70. So here I am checking. I entered into a contract to buy foreign currency $2 lakh. I anticipated $1 is equal to 80 initially, but now $1 is equal to 70. Is it a gain or loss for me? I contracted to buy $1 at loss. So here I should pass the journal entry P&L to derivative financial liability conditions are potentially unfavorable because I thought I'll get $1 lakh and the rate will be 80, but now I anticipation is only 70. It's a loss. Derivative financial liability $2 lakhs into 10, 20 lakhs. Being the loss recognized. Okay. Now 31st December 2023, it is a loss. We recorded loss of 20 lakhs. We recorded loss. Now next reporting date is 31st March. Spot rate is 85. Then what is to be done if spot rate is 85? Is it gain or loss? So derivative 31st March 24. Derivative financial asset you recognize 2 lakhs into 5, 10 lakhs. Okay. Reverse derivative financial liability already recognized to P&L 30 lakhs. Then then 31st March 24. 31st March 24, you are selling the equipment. What is the journal entry when you sell the equipment? Bank or trade receivables to sales. Because for the one who's purchasing the equipment, it is a PP. The one who is selling the equipment, it is sales. Yes or no? Sales. So to sales, 160 lakhs. Bank or trade receivables? Bank. How much should be bank? If I receive it, sales 160 lakhs. When you receive, you are getting $2 lakh. And what is the value of $1? 85. Value of $1 is 85. So 2 lakhs into 85. 170. You could have passed split entry, but we are doing combined entry. Derivative asset, financial asset. 160 lakhs is your sales value. 160 lakhs is your sales value. Apart from that, you also got a derivative gain. That is how total 170 lakhs. Is it okay? Then doubts under. Sorry. If there is a doubt, you ask, or else we'll move on to prepayment option. This derivative asset P and L ലേക്ക് പോകും. Derivative asset account is closed. We already can this to P and L gain already transferred. We recognized an asset 10 lakhs that is reversed. Okay. Okay, le. What about others who are not responding? Can I assume it is okay? And shall we move on? Or is there a doubt? എന്തെങ്കിലും ഇതിൽ ഒന്നുകൂടെ പറഞ്ഞു തരാനുണ്ടോ? Okay. Now, what is the accounting in the books of Dark Limited? In the books of Dark, journal entry was asked in the books of Bright. What is the accounting in the books of Dark? In the books of, if it is in the books of Dark Limited, it is not sale of equipment, it will be purchase of equipment. It is purchase of equipment at 160 lakhs. And forward contract to pay. You need to pay dollars. That is forward contract to. We'll pay dollars, we'll make it as sell dollars at 2 lakhs, $2 lakh at rupees 80. Okay. So starting as usual, derivative contract, no entry. Then first reporting date and first reporting date, $1 is equal to it has become 70. $1 it has become 70. I contracted to sell dollar at rupees 80, but now $1 is for somebody who has to pay dollars. I thought $1 is equal to 80, but finally $1 is equal to only 70. So is it a gain or loss for you? Gain. So for the party who has to sell dollar, initially it is derivative asset to P&L. Just opposite set of journal entries. Derivative asset to P&L. So you're contracted to sell at rupees 80. Now market value is falling means I'm happy. Still I can sell at 80. Yeah. But finally it has become 85. Then it is a loss. I contracted to sell at 80. If there was no such contract, I would have received 85. So it's a loss. So what I'll do? I'll reverse asset. Asset will be credited. I'll have to create derivative financial liability, P&L debit. Just reverse entry. Reverse. Reverse entry. I'll pass. Now at the time of settlement, PP debit 160 lakhs. But I have to finally pay to bank or trade payables. I had to pay 170 lakhs. And I'm settling derivative liability. Then this would have been the entry in the books of Bright. Okay, enough. Now, okay. Now, our prepayment option in debt instrument. Our area is prepayment option in debt instrument. So that prepayment option debt instrument also not going in a detailed manner because we have only very small area there. Prepayment option in debt instrument. So in embedded derivative, financial liability or equity. As I said, study material is not giving a guidance, but we normally take that issue proceeds, a portion of equity, portion of liability, a portion of derivative element also. We'll calculate that. Then purchase or sale of a non-financial asset denominated in foreign currency. Okay. Prepayment option in debt instrument. Prepayment option in debt instrument. So there is a question in our study material, so that can be asked. Nothing, no practice questions, nothing has been added on these areas. Financial instruments, only 6 questions added, and all those six questions are basic kind of questions. ഒരു കോംപ്ലിക്കേറ്റഡ് ആയിട്ടുള്ള ഒരു ക്വസ്റ്റനും ആഡ് ചെയ്തിട്ടില്ല പ്രാക്ടീസിൽ ന്യൂ ക്വസ്റ്റൻസിൽ. So here prepayment option in debt instrument. What is this prepayment option in debt instrument? See, there is a question in our study material, that is, a company has taken a loan of, on 1st April 2025, a company has taken a loan of 100 crores from a bank. Okay, and interest rate agreed is 11%. There is a prepayment option. You can prepay the loan. There is a prepayment option. Prepayment penalty. Prepayment penalty agreed is 3%. Prepayment penalty agreed is 3%. Term of loan is 6 years. And if there was no prepayment option, interest rate would have been 12%. So how the loan to be accounted? As per Ind AS 109. Did you understand the question? 1st April 25, loan, we have taken a loan of 100 crores. The term of the loan is 6 years and the interest rate of the loan is 11%. There is a prepayment option. The question is telling you, or in that loan, there is an option given. You can prepay. 6 years is a long term. Within 6 years, you can prepay the loan. But there is always, when you prepay, there is always a prepayment penalty. Whenever there is a prepayment penalty will be there. Okay. There will be a prepayment penalty. There will be a prepayment penalty. So, prepayment penalty already agreed is, prepayment penalty already agreed is how much? 3%. So, here, if there was no prepayment option, if you are not asking for a prepayment option, interest rate would be how much? Interest rate would be 12%. If you are not asking for prepayment option, the interest rate would be 12%. So how this loan is to be accounted? Okay. So I don't understand what is the connection between this question and an embedded derivative. What is the derivative element in this question case? In the previous example, I easily understood the derivative element is, in the previous question, I easily understood derivative element is the dollar rate. Dollar rate keeps fluctuating. But here, what is the derivative element? I don't understand what the derivative element is. Okay. Now, what the standard says, Ind AS 109 specifically mentions if a loan, a liability contains a prepayment option, there is a derivative element. What derivative element? That is, if the market rate declines, what if the market rate is 8% now? Market rate 8% means I have taken a loan of 100 crores. Yes. And what if the market and the interest I have to pay is 11%? If there was no prepayment option, 12%. So let's assume there is no prepayment option, then you are paying 12 crore as your interest. And it is reverse actually. Interest is 11%. 12% if it is the interest. I have to pay how much interest every year? 12 crore interest I need to pay. Are you following? That is, I've taken a loan. And as per the loan agreement, I have to pay 12 crore interest every year. Every year I need to pay 12 crore interest. Correct? Every year I need to pay 12 crores interest. What if after 1 year, if the market rate of interest, let's forget about all this prepayment option and all, if the market rate is 8%, still I need to pay 12 crore interest. Yes or no? Because as per the agreement with me and the bank, I need to pay 12 crore interest. എനിക്ക് 12 crores interest pay ചെയ്യണല്ലോ. I need to pay 12 crore interest. അല്ലേ? If the market rate is only 8% or market rate fell to 7%, still I need to pay this 12 crore interest. Which means I am paying 5 crores or 4 crores extra. So what the entities will do? When the market rate of interest keeps fluctuating, what entities will do is they will immediately prepay the loan. They will prepay the loan and take the new loan at 7% interest or 8% interest, which means every year there could be savings. Did you understand? So if there is when the market rate fluctuates, if the market rate is increasing, there is no option, there is no benefit for the entity to go for prepayment. But when the market rate fluctuates, that is decreases, it is always better to close that loan and take it as a new loan agreement. Enter into a loan agreement, close the new loan, close the old loan and take a new loan. Yes. Close the existing loan with a higher interest rate and take a new loan. So there is a possibility that you will, if the market rate reduces, there is a possibility that you will prepay the loan. But what is the problem when an entity prepay the loan? There will be prepayment penalty. You know how much will be prepayment penalty? It will be a high amount. It can be 10% or 11%. 1 year's interest. Then to prepay, you need to pay 12% interest, means 12 crores you need to prepay extra. Then it is going to be a loss for you. Prepayment becomes a loss. So to avoid that, what the entity has already done at the time of entering into the contract itself, you have taken a prepayment option. So in my example, you have taken a prepayment option. There is a correction. What is that? Because you have prepayment option, your interest rate is 12%. Bank is charging you a higher interest rate. If there was no prepayment option, the interest would have been 11%. So you already agreed with the bank that if I prepay, you can charge me only 3%. Don't charge a higher prepayment penalty, charge me a 3% penalty. Okay, so you have the rights to prepay and the prepayment penalty will be 3%. So how this will be accounted? The standard says there is a derivative element in this loan. What derivative element? Whether it will be prepaid or not prepaid depends on the market fluctuation, market rate of interest. Yes or no? Market rate keeps fluctuating. If the market rate reduces, there's a chance for prepayment. Market rate increases, there is no chance for prepayment. So whether you prepay or not depends on the market fluctuation. So value based on the value of market, there is a chance for repayment based on the market rate. So there is a derivative element. So what we should do? Here what we should do, what is to be done is what? Without calculations, see what are the options given. Hmm? Okay. Compute the fair value of loan if there was no prepayment. Compute the fair value of loan if there was no. What are the steps to be done? Compute the fair value of loan if there was no prepayment. Okay. Means, yes. Calculation of fair value of loan if there was no prepayment. Okay. That is year 1 to 6. You have a payment of, you already contracted to make a payment of 12 lakh. 12 lakh, not 12 lakhs, 12 crore. Because the interest rate is 12%. 12 crore into annuity factor at 11 percentage for 6 years. Why annuity factor at 11 percentage? If there were, compute the fair value of loan if there was no prepayment option. If there was no prepayment option, my market rate of interest is 11%. Market rate of interest is 11%. So I'll calculate 1, 2, 3, 4, 5, 6. So if 11 percentage is the interest rate, if you are paying this 12 crores every year and 100 crores, then you had to take a loan of 104.23. You have, see, the fair value of this loan is, you should have taken a loan of 104.23. Then only you need to pay 12, 12, 12 at 11 percentage interest and 112 at the last year. Okay, fair value. Fair value of the loan if there was no prepayment. Fine. Then what is my next step? Compute the fair value of loan if there was no prepayment, that is present value of contractual cash flows discounted at market rate if there was no prepayment. Okay, that we have done. Now that is not clear for me. Okay, wait, we'll find out. Prepare amortization table and compare closing balance of liability with the prepayment amount. Prepare amortization table. Okay, I'll prepare amortization table. Year 1, 2, 3, 4, 5, 6. Opening balance 104.23. Then unwind it at 104.23 into 11%. 11.46. Repayment is, first year repayment is 12 crore. So closing balance. Then they compare it with the prepayment value and difference. Closing balance, prepayment value difference. %, 11.41. $103.09 into 11%, 11.34. Repayment 12, 12, 12, and 112. $102.43. 102.43 into 11%, 11.26. See, amortization table we are preparing. Okay. If 104.23 was my loan amount, then what is the amortization table? Fair value of loan we have amortized, and this is our amortization table. Now compare it with, if you had to pay, if you are repaying the amount early, that is prepayment. If there was prepayment, what is the amount to be prepaid? So what are the steps I am doing? See, we are doing as per 109. If you have taken a loan with prepayment option, what are the steps? So if there was no prepayment, your value of loan in the books is 103.69 and you are prepaying 103. Is there a great difference? What is the difference? Difference 0.69. Okay, write it in percentage. 0.69 divided by 103.69 into 100. 0.6 percentage. Okay. Here difference is 0.09. That is 0.09 divided by 103.09 into 100. 0.01, 0.087. 0.08. Okay, so 102.43 minus 103.57. 0.57 divided by 102.43 into 100. 0.556 or 0.6%. Round off. You can round off the differences. Now 101.69. See why we are doing this? I am coming to that. Divided by 101.69 into 100. That is 1.28 percentage. And last, 2.1%. So at the beginning of the year, that is at the time when you have taken the loan, at the time when you have taken the loan, at the time when you have taken the loan, before passing the accounting entry for the loan, before passing the accounting entry for the loan, you should do this calculation. Identify the differences. So here differences 0.6, 0.08, 0.5511, 0.28. What is this difference? If there was no prepayment, what is this value? Fair value of loan if there was no prepayment. If there was no prepayment, if there was no prepayment, if there was no prepayment, what is the fair value? If there is prepayment, what is the amount to be paid? What is the difference? If you feel the difference is a great difference, then you need to separate, or else no need to separate. There is no special or additional benefit from derivative asset prepayment option. Don't separate. Did you understand? That is, let me read this once more. Compute the fair value of loan if there was no prepayment. Compute the fair value of loan if there was no prepayment. That is 104.23. How did you calculate this? Present value of contractual cash flows discounted at market rate if there was no prepayment. Okay, that we have done. Prepare amortization table. Okay. Compute the closing balance of liability and compare it with the prepayment amount. Okay. If it is, that is, when I do the comparison, if it is approximately equal, same, if both are same, approximately this is same, approximately both are equal, then approximately same, then there is no significant difference. No need to separate the prepayment feature, or else separate. Did you understand that? If you feel this is same, approximately same, there is no significant difference, then no need to separate. But if you feel there is a significant difference, approximately not equal, then derivative feature, there is a derivative feature, that is prepayment option, which requires separation. Did you understand that? Okay. So my standard, I used to say in this question, they are talking only up to this. In the answer, I told you there is a question on the study material, derivative, illustration number 13. Now they are just saying, compare and say whether separation is required or not. Not accounting. They are not asking accounting. Compare and say whether separation is required. So answer is as per 109. If approximately equal, no separation. If not approximately equal, separation is required. So management should identify a policy and see whether it is approximately equal or not. Accordingly, it can be separated. If management feels it is approximately equal, then separation is not required. If management feels it is not approximately equal, separation is required. That's it. That is what given in the answer. Let me show you 1 second. Three, 24, 25. No. The question എടുക്കണ്ടല്ലോ. The same question. What if it is separated? I have given an answer. And I'm just I'm going through. Hmm. Earlier adoption. Derecognition. So this question, as I said, I don't know whether that they will ask or not, but just have an idea. In theory portions, you should be very clear. That's it. Financial guarantee, derivative accounting. This is the question. Prepayment option debt instrument, which I was saying. This is the study material answer. 11%. Identify the embedded derivative. Host contract is the debt instrument. Option to prepay is the embedded derivative. So here they have calculated 104.22. Amortized cost. Study material answer copy paste in this. So we compared it with and identified the difference. The management of entity PQR may formulate an accounting policy to determine what is approximately equal. If the management feels that if a difference of 2% will indicate is not approximately equal, then it can be separated. So here there is a difference of 2% finally. So if you feel that 2% difference is approximately equal, you can split, or else no need to separate. Okay. It will be separated and accounted if it is not approximately equal. So that's it. This is the answer given in the study material. But what we have done is, if it is approximately equal, finally അതുകൂടെ ഒന്ന് പറഞ്ഞിട്ട് we'll close. If you feel it is approximately equal, what is the accounting? If approximately not equal, approximately equal we'll write first. Approximately equal. If approximately not equal. So approximately equal means separation not required. Separation is required. So here what is the entry? Bank to loan. 100 crores. Recognizes interest at 12%. Ignore prepayment feature. Because prepayment feature does not have any importance, ignore prepayment feature. Did you understand? If it is approximately equal, this is the accounting to be done. Ignore the prepayment feature. If approximately not equal, separation is required, then prepayment feature is having some relevance. So the accounting should be bank account debit 100 crores. Now itself there is a derivative asset prepayment option. Benefit you have 4.23. Because of that market fluctuations 12% and 11% even now. you have a benefit. So derivative asset 4.23 to loan 104.23. Recognize interest expense at 11%. Off market way. Off market means off market terms where we are charging at a lower rate. Is it like that? With the derivative with a prepayment option. It can come, but generally with the prepayment option and also lower interest rate, if to employees it could happen. In that question which we did, financial asset to employees or other, normally banking, if you take a loan, such will banking, if you're taking a loan, it is market rate of interest. If you're taking a finance, then it will be always at market rate of interest. Only with the related parties like employees, or in case of this lease, this off market terms will come. Generally off market terms will not come when I take a loan from a bank. So that's it. We are not sitting on this question. So far not asked for exam, can come. Okay. Now, what is next? Next is so here embedded derivative. Up to this you should be careful. Embedded derivative clear. Now, derecognition of financial liability. Derecognition of financial liability. Okay. Derecognition of financial liability. A liability in your books, very important. Derecognition part I'll mark as very, very important. Derecognition of financial liability. Okay, come on. What is this? When do you derecognize a liability from the books? Liability will be derecognized when all the contractual cash flows are settled. All the cash flows are settled, then it will be automatically derecognized. Interest to liability, liability to bank, interest to liability, liability to bank. You already settled it. Okay, fine. Then SDR, strategic debt restructuring. Strategic debt restructuring means renegotiation of the existing terms. Then old liability will be recognized as settled and new liability will be additionally recorded. No, I didn't understand that. Okay, we'll see. Then you have an area to study early redemption of compound financial instruments. Early redemption, early repayment of compound financial instruments. Okay, so financial liabilities will be derecognized from the books when all the contractual cash flows are settled, or when there is a strategic debt restructuring, or when there is an early redemption of compound financial instruments. So let's study. So when all the contractual cash flows are settled, then there is no additional area to be discussed. Normally, as usual, all the liabilities are settled. That's it. But if it is SDR, strategic debt restructuring, renegotiation of existing terms, then you have some contractual cash flows already, existing terms already, and now you are going to change the existing terms. There is a modification. So here you need to do a 10% test. Whenever there is SDR kind of question, my step number 1 is, whenever there is an SDR, step number 1 is 10% test. Step number 1 in case of SDR is 10% test. 10% test. 10% test. What is this 10% test? Compare. But if 10% test is satisfied, we should go for extinguishment accounting, and 10% test failed, we should go for modification accounting. So what is this? Extinguishment accounting, modification accounting, SDR, and you said it is very, very important. Yes. So what are the steps to be done? Okay. 10% test. Compare. Compare present value of cash flows as per revised terms. Compare present value of cash flows as per revised terms. Compare present value of cash flows as per revised terms, including legal fees, transaction cost, etc. You take the present value of cash flows as per revised terms. Revised terms. Present value of cash flows as per revised terms. Okay. Including legal fees, including transaction cost. Because of this modification, what are the outflows? Outflows as a result of change. What are the outflows as a result of change? Present value of cash flows as per revised terms, including legal fees, transaction cost, etc. Okay. Compare it with present value of cash flows as per original terms. Compare it with the present value of cash flows as per original terms. Original. If there was no modification, what is the change? Okay. Compare, and if the difference is equal to or more than 10%. If the difference is equal to or more than 10%, then 10% test satisfied, you should go for extinguishment accounting. Then you should go for extinguishment accounting. Extinguishment accounting. Then you should go for extinguishment accounting. Okay. Okay. Point to be remembered in case of 10% test. 10% test. What is the point to be remembered while doing 10% test? Okay. Both set of cash flows. Both set of cash flows should be discounted at. Both set of cash flows should be discounted at original EIR. Both set of cash flows should be discounted at then only it is comparable. Then only to make it comparable. Then only it will be comparable. Then only it is comparable. Then only it will be comparable. Are you getting? Otherwise, this cash flows, old cash flows, new cash flows, you discount it at different rates, then it is not comparable. It is not comparable. To make it comparable, both should be discounted at the same EIR, that is original EIR. Okay. Now, what is to be done in case of extinguishment accounting? What is to be done in case of extinguishment accounting? What is to be done in case of extinguishment accounting? Derecognize the book value of existing liability. Derecognize the book value of existing liability. Okay, derecognize the book value. Existing loan has to be derecognized, closed. Recognize the new loan at fair value minus. So you cancel old loan because there are some modifications. As a result of modifications, new liability is to be recorded. So cancel your old liability. Cancel old liability. Recognize new liability. New liability should be recorded at what value? fair value minus transaction cost. New liability should be recorded at fair value minus transaction cost, and gain or loss is transferred to statement of P&L. Gain or loss is transferred to statement of P&L. Any legal fees incurred is transferred to statement of P&L. What? Old liability, new liability difference to statement of P&L. Any legal fees out of modification, any legal fees out of modification is to be transferred to statement of P&L. See, now a new liability is directly related cost. Direct cost related to new liability is transaction cost. Transaction cost means liability related to the new, cost related to the new liability is transaction cost. Legal fees out of modification should be transferred to statement of P&L. Okay. So literally this is my entry. Old loan debit. Cancel old loan. Okay. Recognize new loan. Okay. Gain or loss is transferred to P&L. Okay. So did you get any question on extinguishment accounting before? Yes. We have a very good question in our material, and that is asked in December 21 attempt. Oh, it is already asked, so it will not come again. I don't know. So Institute always repeats question. You can get question of this derecognition in the upcoming exam. So we'll go through what is the treatment if there is extinguishment accounting. Modification also, time being, let me explain. Modification accounting, when there is no substantial modification, that is if 10% test failed, adjust transaction cost or legal fees against book value of loan and recalculate EIR, prepare amortization table. Okay, bah. Let's try this derecognition question. This is it, yes. Wait to question number 24, 25. Dear 24. We'll discuss this 24 and 25. Yes. Wheel Company Limited borrowed 500 lakhs. This is your study material, TYK question. Wheel Company Limited borrowed 500 lakhs from a bank on 1st January 2011. The original terms of the loan were interest rate 11%. So you have taken a loan of 550 lakhs. 50 crores. You've taken a loan of 50 crores. Interest rate is 11%. Principal is repaid in 5 equal installments. Payment of interest on accrual basis. Payment of interest on accrual basis. Upfront processing fees is 58,70,096. What is this upfront processing fees? Transaction cost deduct from fair value. Okay. Effective interest rate is whenever there is transaction cost, your interest, you paid more. Apart from the normal interest, you are paying more expense for this loan. So there will be, the effective interest rate will be much higher. It is 11.5%. On December 2012. Okay, on December 2012. That is, you have taken loan on 1st January 2011. 31st December 2011. 31st December 2011 is first year. 31st December 2012 is second year. Wheel Company approached the bank citing liquidity issues in meeting the cash flows required for immediate installments and renegotiated the terms of the loan with the bank as follows. Interest rate 15%. Okay. Repayment of outstanding principal 10 equal installments starting from 31st December 2030. payment of interest on annual basis. Before approaching the bank, Wheel Company Limited made the interest payment. Record the journal entries in the books of Wheel Company Limited till 31st December 13 after giving effect of the changes in terms of the loan on 31st December 2012. What is this? What is given here? That is, we had a loan. So repayment is in 10 equal installments, which means you need to pay 10 crore, 10 crore, 10 crore, 10 crore, 10 crore along with interest. Interest should be paid 50 crores into 11%, 5.5 crores. Second year 4.4 crore, 3.3 crore, 2.2 crore and 1.1 crore. These are the repayments required. Yes or no? 15.5, 14.4, 13.3, 12.2 and 11.1 were the repayments required. Yes. Alle? Yes. So, Nangal first year you repaid. Second year you paid only what? Second year you paid only interest. Second year you paid only interest. 4.4 crores interest only you paid. Okay. So which means 40 crores liability is outstanding. Okay. At that time, you approached the bank citing liquidity issues and renegotiated for the terms, and maybe you don't have funds and you need more time. So bank has increased the interest rate to 15% and repayment in 10 equal installments. How much is the outstanding loan? 40 crore. Bank asked, see, as per the agreement, you need not pay this huge principal amount of 10 crores. You need to pay 4 crore along with interest. Okay. Before approaching the interest is paid. So how this modification is to be accounted? How this SDR, debt restructuring, is to be accounted? So what should be the answer? We are not trying this. Let's discuss this huge figure, value figures, and you just practice it at home. So we'll discuss. How should I present this answer for exam? How I'll present first. If I get this question for exam, so December 21, we got this for 12 marks. Question number 1, 12 marks. So what is this? As per Ind AS 109. Financial liability should be initially recorded at fair value less transaction cost. Okay. So what is because the market rate of interest is not given. Starting. Actual rate of interest is 11%. Yes. On that date, market rate of interest is not given. So at the market rate of interest, as the market rate of interest is not given, fair value is equal to transaction price. Yes or no? Yeah. Fair value is equal to, when actual rate and market rate is same, fair value is equal to actual loan amount, transaction price of fair value is 50 crore. Okay. Deduct transaction cost. Fair value minus transaction cost. The loan should be initially recorded at 49 crore 41 lakh 29,904. Are you okay? Initially. So maybe for this part there will be 1 mark or 2 marks allocated. Yes. Now prepare the amortization table. So they are asking journal entry from the beginning till 31st December 13. So that is 1, 2, 3, 3 years. So first entry is bank account debit to loan 49 crore 41 lakh 29,904. Yes. Then prepare amortization table. Amortization table we need to prepare only for 2 years. Why? Why we need to prepare only for 2 years? Because after 2 years, my amortization table is changing because the loan terms has changed after 2 years. So first year, 49 lakh 41 29,904. Interest. Whenever there is EIR, interest should be calculated at. When there is EIR, interest should be computed at EIR. Okay. Repayment, first year we repaid 15 crore 50 lakhs closing balance. Second year, interest accrued, but we paid only the interest, actual interest 4 lakh 40. Therefore, this is the closing balance. As on today, this is the closing balance. This is the closing balance. Okay. Before SDR, this is the position. Before SDR, this is the position. Okay. Yes. So now you are approaching the bank. You are going to the bank to meet the bank people. Okay. As there is debt restructuring, the entity need to identify whether it resulted in substantial modification or not. If it is resulting in substantial modification, extinguishment. 10% test satisfied, substantial modification, extinguishment accounting. 10% test failed, no substantial modification accounting, so modification accounting. So identify whether there is substantial modification or not, we go for 10% test. Okay, to identify whether there is substantial modification, we go for 10% test. So what is 10% test? 10% test, you have to take cash flows as per revised term. New terms, what are the cash flows? So that you need to calculate. So new terms, what are the cash flows which you need to pay? Every year the principal repayment is 4 crore, 4 crore, 4 crore, 4 crore. For 10 years, 4 crores. Okay. Then every year I need to pay interest. So interest first year 40 crores into 15%, 6 crores. Then 36 crores into 15%. So the lot of calculations. No. What you need to do is just find out what is the repayment every year. What is the repayment? Every year repayment is 4 crore, right? Every year principal repayment is 4 crore. 4 crore into 15 percentage, that is 4 crore into 15 percentage, 0.6 crores interest savings will be there every year. So no 4 into 15 percentage, 0.6 crores interest savings will be there every year. When it is equal repayment, interest savings will be every year 0.6 crores. So blindly you can take, you can avoid all these calculations. You can do first year if it is 10 crore, second year minus 0.6, third year minus 0.6, fourth year minus 0.6, minus 0.6, minus 0.6, minus 0.6, minus 0.6. Last year only 4 crore pending. 4 crore into 15%. Total repayment is 4.6 crores. Okay. So discount it at original EIR. In your books, what was the original EIR? In the books, what was the original EIR? In the books, original EIR is 11.5%. Therefore, we discounted and identified 45.112. What is this? 4, this is for 10% test. Present value of revised cash flows. Okay. Present value of cash flows as per original terms is? From where did you get this? 39.75. From where did you get this amount? 39.75 crores. Amortization table. Because in the amortization table, closing balance represents always present value of remaining cash flows. So, okay, difference 5.362. 5.362 divided by old loan 39.75 or 76 into 100. We calculated the percentage as 13.48, which means 10% test is satisfied. That what do you mean by 10% test? There is substantial difference. As per the old terms, you need to pay only 39.75. But as per the new terms, you need to pay 45.112. So there is 5.362 crores difference, substantial difference. Your old loans compared to old loan, 10% കൂടുതൽ you need to pay. So it is substantial difference. It is 10 extinguishment accounting is to be done. So there is substantial modification. Extinguishment accounting is to be done. Do you recognize the book value of existing loan at? Okay. De-recognize. Old loan you cancel. Debit old loan. Credit new loan at fair value. Credit new loan at fair value. New loan should be recorded at fair value, which means 40 lakhs. Why did you write 40 lakhs? New loan. New loan outstanding amount is 40, not 40 lakhs, 40 crore. New loan outstanding amount is 40 crore. Okay. Is that the fair value? Yes. Because on that date, on the date of extinguishment, on 31st December, you changed. And on that date, interest rate is 15%. This is actual interest rate or market interest rate. Is the question specifying actual interest rate or market interest rate? Is the question specifically mentioning that this is actual interest or market interest? No, interest rate is 15%. It is actual, which is equal to market in the absence of information. So new loan should be recorded 40 lakhs itself. Whenever market rate and actual rate specifically, they different and it is separate. If they give, then transaction price and fair value could be different. But as long as that is not separately given, it is the same. Are you clear? So here old loan you debit, new loan you recognize, there is a difference to be recognized in P&L. So what is the journal entry to be passed? Journal entry, I thought I have written, but journal entry is not passed. So what is the journal entry to be passed? Starting onwards, quickly. First entry is bank to loan. 49 lakh 41,29,904 bank to loan. Interest to loan, loan to bank. Interest to loan, loan to bank. Yes or no? Interest to loan, loan to bank. Interest to loan, loan to bank. Then there is calculation. After calculation, what is my next entry? Derecognition entry. Derecognition entry is old loan debit 39 crore 74 lakh 89,650 to new loan you are recording at 40 lakhs. So it's a loss P&L difference. That's it. Now what is next? Next year what we will do? So this is the entry for derecognition. The next year what is to be done? Next year is what I have written. Interest to loan. Next year interest is 600 lakhs. 600 lakhs. 6 crores. Loan to bank. You will repay 10 crores. The next again interest to loan. Next year interest 5 crore 60 lakhs. Repayment loan to bank 9 crore 60 lakhs. It will be like this. It will be like that. 5 crore 40 lakhs. 5.4 is the second year's interest. First year interest is 600 lakhs means minus you need to record 6 lakhs. 5 crore 40 lakhs will be 60 lakhs. Interest to loan, non to bank. Then it will be continued. മനസ്സിലായോ? Derecognition if it is extinguishment accounting. Is there anything that I need to explain? So this will be complete only if you try the questions at your source. You have some questions with you, or you have study material with you, you have some workbooks with you. So you should go through the rest of the questions, then only it will be complete. That you should do. Initially അതൊക്കെ പക്കയായിരിക്കും, slowly നമ്മുടെ അടുത്ത് നിന്ന് അത് പോയിക്കൊണ്ടിരിക്കും, but you should be on the track and still you are having time. നമ്മളിങ്ങനെ ഒരു റിവിഷൻ കഴിഞ്ഞിട്ട് സ്റ്റിൽ യു ആർ ഹാവിംഗ് ടൈം ടു സോൾവ് എവറിഥിങ്. മൾട്ടിപ്പിൾ റിവിഷൻസ് ചെയ്യണം. എത്ര ടൈംസ് ഇത് കേൾക്കാൻ പറ്റണോ അത്രയും ബെറ്റർ ആണ്. then it will be more and more clear. Okay. Now modification. Modification will take a small break. But we'll try this question number 25. Yes. Okay. 22. We'll start at 10 minutes break we'll take. We'll start at 11:30 to 35 we'll start. On 1st January 2010, XYZ, so we have not received any modification questions so far. So on 1st January 2010, XYZ issues 10-year bonds for 10 lakhs, bearing interest at the rate of 10% payable on 31st December each year. So on 1st January 2010, X Limited issues 10-year bonds, 10-year bonds for 10 lakhs, bearing interest at the rate of 10%, payable on 31st December each year. The bonds are redeemable on 31st December 2019 for 10 lakhs. That is after 10 years. Because you issued in 2010. 10, 1 year, 11, 12, 13, 19. So 10 years. Okay. No costs or fees are incurred. So initially there was no cost, no fees, which means there is no transaction cost. The effective interest is there for 10%. Okay, effective interest is there for 10%. On 1st January 2015, after 5 years. 1st January 2015, that is after 5 years, XYZ and the bondholders agreed to a modification in accordance with which no further interest payments are made. No further interest payments are made. The bonds are redeemed on the original date, that is 16 lakhs. Legal and other fees 50 lakhs. Analyze whether the modification accounting will apply or not as per Ind AS. If yes, calculate revised DIR and determine the amortized cost and interest expense to be booked in future periods. Not the relevant PV factor. They have given some factors. Okay. So we have issued a bond. So when we issued the bond, at the time of issue, what is the journal entry? We issued the bond, the entry is bank account debit to 10% bonds. How much? 10 lakhs. Bank account debit to 10% bonds, 10 lakhs. Okay. No costs or fees are incurred. Fine. The effective interest is there for 10%. Effective interest is there for 10%. Effective interest is there for 10%. Okay. On 1st January 2015, that is after 5 years, XYZ Limited and bondholders agreed to a modification. So 5 years passed. So at the end of, so during that first 5 years, what are the journal entries? During the first 5 years, my journal entries will be interest to bond, bond to bank, and the amount will be same. Interest rates are not different. So very good. The amount, the interest rates are not different. So it is same. So year end, every year end, 10 lakhs. Interest to bond, 1 lakh. Repayment, 1 lakh. So closing balance, 10 lakhs. Next year, 10 lakhs, 1 lakh interest. Repayment 1 lakh, closing balance 10 lakhs. So it is the same. At the end of year 5, it is 10 lakhs. At the end of year 5, it is 10 lakhs. Okay. At the end of year 5, it is 10 lakhs. At this time, they are going for a, going for what? Going for modification. And if there is modification, my step number 1 is, Modification, if I find my step number 1 is 10 percentage test. My step number 1 is 10 percentage test. My step number 1 is 10 percentage test. So what is to be done in 10 percentage test? 10 percentage test, PV of cash flows as per revised terms. PV of cash flows as per revised terms. PV of cash flows as per revised terms. That is year 5, 16 lakhs is to be paid. PV factor at 10 percentage. So, okay. So, why? No further interest payments are there. And bonds are redeemed on original due date 16 lakhs after 5 years. And there is a legal fees which I paid right now. That also you should take. So, what is the total present value of cash flows out of this modification? 10 lakh 43,474. Are you okay? Yes. Now, present value of cash flows as per existing terms. Present value of cash flows as per existing terms, 10 lakhs. Yes. So, difference is 43,474. Difference is 43,474. So, 43,474 divided by 10 lakhs, it is 4.34%, less than 10%. 10% test failed. Less than 10%. So, we'll say 10% test is failed. 10% test is failed. There is no substantial modification. Modification accounting is to be done. Are you clear? Yes. Legal fees or transaction cost incurred is adjusted against the book value of loan. Legal fees or transaction cost is incurred. What is the treatment when there is modification accounting? Come on, this is the difference. Come on, everyone, please listen. If it is extinguishment accounting, old liability debit, new liability you credit, difference to P&L. But here if it is modification accounting, whatever legal fees or transaction cost, there is no bifurcation. Whether it is legal fees or whether it is transaction cost, adjust it against the book value of loan. How much was the book value of loan? 10 lakhs. Already 10 lakhs. How much did you incur any legal fees or transaction cost? Yes, 50,000. Adjust it against the value of loan. Oh, I see. Which means when you incur legal fees, you pass the journal entry legal fees to bank. Okay. Legal fees, can I go to P&L? No, don't go to P&L. Loan to legal fees. Legal fees should be adjusted against the value of loan, means the journal entry should be loan to legal fees. Loan to legal fees. Are you clear? Yes. Now loan balance has become 9,50,000. I want all of you to listen. Loan balance is now 9,50,000. Yes. And after 5 years, you need to repay 16 lakhs. Is there interest payments during this 5-year period? Interest payments? No. No. Then what we will do? Find out an EIR. Find out EIR. Find out EIR. That can match. You incur some expense anyway. That is why 9 lakh 50 liability, you are finally settling it at 16 lakhs. You are incurring some expense. Yes, we are incurring expense. We are incurring expense. We are incurring expense. Okay, that expense you find out. EIR you find out. How do I calculate EIR? Present value of 16 lakhs is equal to 9 lakh 50. Using some rate, when you use a rate, your present value of 16 lakhs is equal to 9 lakh 50. So what is that rate? Find out. Guess it and find out. You already calculated at 10 percentage the 16 lakhs. You already calculated it as 16 lakhs into 10%. At 10 percentage, it is 9 lakh 93,474. So at 10 percentage, it is 9 lakh 93,474. 10 percentage, it is 9 lakh 93,474. So minus 9,50,000, 43,474 difference you have. So next you should try at a higher rate or lower rate. So this difference you already know. At 10% is not the rate. At 10% it will be 9,93,474. It should be 9,50,000, 16 lakhs when you discount. So you should use a higher rate. If you use a higher rate, higher the discounting factor, lower the present value. Because I need to make this 9,93,474 equal to 9,50,000. So use the higher rate. So you will use some rates are given in the question, but I'll take 12 percentage. So if we take 12 percentage, again 1 divided by 1.1212345 0.5674 5674. So it is 16 lakhs into 0.5674, 16 lakhs into 0.5674, 9 lakh 7,840. So what I need was 9,50,000. So 42,160 negative. So we need to interpolate and find out. Yes or no? Interpolation. Interpolate and find out. How do you interpolate? Now you all have done AFM, you're all masters in it. So I'll calculate IRR as lower rate plus NPV at lower rate 43,474 divided by 43,474 plus 42,160 into range difference 2. 43,474 plus 42,160. 85,634. 85,634. 85,634 into 2. 1.015. 11%. We'll take it as 10.999 or 11% or 11.01. 11.01 is fine. So if you use the discounting factors given in this question, they have given discounting factors as 6 factors, then you will get 10.99%. It's all okay, same. Okay. So why should I calculate that rate? Because when I use that rate, loan balance is now 9,50,000. Recalculate EIR. So it is 9,50,000. Interest 9,50,000 into 11%. 10,04,500. Then closing. There is no repayment now. So every year I'll charge interest. And finally my loan balance becomes 16 lakhs. When it is 16 lakhs, I'll pay. When it is 16 lakhs, I'll repay 16 lakhs to bank. Modification accounting. What is the accounting at the time of modification? Adjust legal fees or transaction cost against loan. Recalculate EIR. That's it. So far, nothing has been asked from this area. They may ask. No question has been asked from this area. They can ask this. So be careful. Okay. Yes. Okay. So that is modification accounting. That is modification accounting. And derecognition. So financial instruments, financial assets, financial liabilities, compound financial instruments, derivatives. Derivatives are always FVTPL. Any gain, any loss, any fair value gain, any fair value loss, always to FVTPL. Derecognition of financial liabilities. Now derecognition of financial assets. Okay. Derecognition of financial assets. Derecognition of financial assets. So again, financial assets is an area our institute has not tested yet. Used to say they can ask a 4 or 5 marks question. That's it. So the whole topic we can get maybe for 4 to 5 marks. Okay. So complete derecognition of financial asset can be a complete derecognition or partial derecognition. It can be complete derecognition or partial derecognition. Complete derecognition, partial derecognition. Complete can be without recourse or with recourse. What do you mean by without recourse? With recourse, risk of bad debts. Risk of bad debts not transferred. Without recourse means risk of bad debts transferred. Okay, complete or partial. So it can be complete or partial. So complete can be of two types, with recourse, without recourse. Okay, fine. If it is without recourse, I derecognize a financial asset without recourse, nothing will come back. So my standard says financial assets are derecognized when all the three conditions are satisfied. What are the three conditions? Control over the asset is transferred. Control transferred. Okay. Risk and reward of the asset is transferred. Contractual cash flows are not expected to be received. You can derecognize an asset when control over the asset is transferred, substantial risk and reward is transferred, contractual cash flows are transferred, then you derecognize the asset completely. Okay. Now, complete derecognition, no risk of bad debts. Then what is the journal entry? Bank to financial asset. Bank. What is the consideration you have received? Consideration received to financial asset. Gain or loss is transferred to statement of P&L. Gain or loss is transferred to statement of P&L. Okay. Okay. Now if it is partial derecognition, not partial, before partial, complete derecognition itself. I'm sorry, complete derecognition itself with recourse. Complete derecognition with recourse. Complete derecognition with recourse. What do you mean by with recourse? Risk of bad debts not transferred. Say if you sold a liability, if you sold, say for example, you already had a loan in your books, loan of 50 lakhs, asset not liability, you had an asset of loan 50 lakhs in your books. Okay, this 50 lakhs you have sold to a factor. In a factoring arrangement, you sold 50 lakhs to a factor. So factor has paid you 48 lakhs. Factor has paid you 48 lakhs, 48 lakhs. And the factor is like, if the loan is not recoverable, the risk of bad debts will come back to you. Which means what? Or അത് വേണ്ട നമുക്ക് example and study material example, so that risk of recourse means that whatever is the bad debts, that bad debts I need to suffer that bad debts, which means I may have to pay the factor the amount. Then what is my entry? What is the accounting of derecognition? Because I sold it. So my standard says, bank, you received some amount. 48 lakhs you received. Yes. Do you have any continuing involvement asset? Recognize continuing involvement asset. Do you remember what is continuing involvement asset? Continuing involvement asset? Yes, continuing involvement asset is equal to, do you have risk over entire carrying amount of asset and compare it with guaranteed, or have you given a guarantee? So carrying amount of asset, compare it with guaranteed value, whichever is lower is the continuing involvement asset. Continuing involvement asset is continuing involvement asset is continuing involvement asset. Continuing involvement asset. Continuing involvement asset is guaranteed value. ഉണ്ടെങ്കിൽ guaranteed value is continuing involvement asset. But my standard is teaching me carrying amount of the asset. If you have not given a guarantee, then on entire loan there is risk. So carrying amount of loan or guaranteed value, whichever is lower. Okay. Now, what is associated liability? Associated liability is continuing involvement asset plus determine the fair value of liability. Determine the fair value of liability. Determine the fair value of liability. Asset value plus fair value of liability, that is expected future cash flows. Present value, if there is a risk, in case of bad debt, you have to pay the amount to the factor, yes or no? In case of that bad debt, you have to bear that loss. Yes, you have to bear the loss. What is the expected cash flows? Take the fair value of that expected cash flows. Okay, fine. I hope that is okay. Now I'll pass the journal entry, bank account debit. If there is with recourse, bank debit, what is your guaranteed amount, or do you have risk on the entire amount or the guaranteed amount? What guaranteed amount? We are saying out of 50 lakhs, if 10 lakhs is not paid, I'll give. That is guaranteed value. 50 lakhs, if there is no repayment, I'll pay. That is the carrying value. Full on risk or guaranteed amount, whichever is lower, is your continuing involvement asset. To financial asset, you derecognize at carrying value. This is it. You derecognize at carrying value. To associate liability, come on. Once more, associate liability is equal to continuing involvement asset plus എന്തായിരുന്നു അത് fair value of liability. So where in my balance sheet, where I'll present, because you're studying financial reporting, where in balance sheet I'll present this continuing involvement asset and associated liability, you will set it off. You will set it off. So it will show only the fair value of liability. It will set off. So the net figure will be fair value of liability. Yes. So that will be shown as a current liability or non-current liability. If it is expected to be settled after 12 months, then non-current liability, and that will be unwinded. That will be recorded at its fair value at the end of each year. Are you understanding? Yes. So there is only one question in our study material on this, but it is very basic. That we'll take later. I mean, later on. See, that is a derecognition of financial asset. So this is question number 17, 18, 19, 20, 24, 25, 25, 26 again. Question number 25, 26. Twenty-four, 25. With recourse. This is your study material question. If at all you are getting a question, something of this nature of question you can get. Entity C agrees with factoring company D to enter into a debt factoring arrangement. Entity C, okay, agrees with factoring company D into a debt factoring arrangement. Okay. Under the terms of the arrangement, the factoring company D agrees to pay 91.5 crores less servicing charge 1.5 crores. Net proceeds 90 crores in exchange of 100% of cash flows of short-term receivables. Okay, so um, C is having some trade receivables. Factoring company will pay 91.5 crores minus 1.5, which means factoring company will pay 90 crores. The receivables have a face value of how much receivables? Receivables have a face value of 100 crores and carrying amount of 95 crores, which means there is an ECL of 5 crore. ECL, expected credit loss of 5 crores. There is an expected credit loss of 5 crores, 95 crores. The customer will be instructed to pay the amounts owed into the bank account of the factoring company. Entity C also writes a guarantee to the factoring company D, under which it will reimburse any credit losses up to 5 crores. It will reimburse any credit losses up to 5 crores over and above the expected credit loss of 5. Guarantee is estimated to have a fair value of 0.5 crores. Guarantee is estimated to have a fair value of 0.5 crores. What is this? Calculate the amount of continuing involvement asset. Calculate the amount of associated liability. Pass necessary journal entry. Shall we discuss this? So here, my loan in the books was having a value of 100 crore. My loan in the books was having a value of 100 crore. Minus there is an expected credit loss of 5 crores. So it is having a final carrying value of 95 crores. On this 95, what is expected credit loss? Actual loss IO. Provisional 5 crores. Expected credit loss means IO. Myself already expecting 5 crore loss. Yes or no? Yes or no? Yes. I already expect a loss of 5. Expectation of 5. So, how much is the amount receivable? 100 crores receivable. I expect a loss of 5. So, balance is 95. And my factor is giving only 90. Okay. And again, we have given a credit loss. We are giving a guarantee of 5 crores. Inim loss vanna, adi 5 crore we suffer. Minus 5 crore factor deducted. Over and above this, if there is a loss, that 5 crore we are giving guarantee. So what is the continuing involvement asset? How much is the continuing involvement asset? Continuing involvement asset is 5 crore. Continuing involvement asset is 5 crore. Okay. Amount of asset is 95 crore. And guarantee amount is 5 crore. Whichever is lower, that is what 5 crores. Okay. Associated liability is guarantee amount, continuing involvement asset amount plus fair value. Okay. So what is the journal entry? We got a cash of 90, continuing involvement asset 5, we derecognize receivables 95, associated liability 5.5. So it is resulting in a loss of 5.5 crores. Resulting in a loss of 5.5 crores. Just see whether it is clear. ECL എന്നൊന്ന് അക്കൗണ്ട് ഉണ്ടാവുമോ ബുക്സിൽ? യെസ്, ECL എന്ന് പറഞ്ഞൊരു അക്കൗണ്ട് ഉണ്ടാവും. അങ്ങനെയാണെങ്കിൽ നോക്ക്, 100 crores provision ECL debit. Effect same അല്ലേ 0.5 അല്ല. Instead of crediting 95, if ECL account ഇവിടെ carrying value of loan എന്നേ പറഞ്ഞിട്ടുള്ളൂ എന്ന് വെച്ചാൽ ECL adjust ചെയ്തു അസറ്റ് വാല്യൂ തന്നെ കുറഞ്ഞു കിടക്കുകയാണ് അല്ല ECL is a separate account എന്നായിരുന്നെങ്കിൽ I will derecognize asset 100. I'll derecognize ECL 5. In both cases, net effect is same. Okay. And can you explain that again? Which one? ECL part. See, here in this question, what they are telling us, ECL is already adjusted and carrying value is 95 crore. ECL, see how, where it is given, see. The receivables have a face value of 100 crores. Receivable account debit balance had a face value of 100 crores and carrying value of 95. Why 95? And somewhere it is given over and above the expected credit loss of 5. So I understood that already that loan is or a loan or trade receivables were having a original carrying value of 100 crores. Now it is having a carrying value of 95 crores, which means ECL is already adjusted. Means reduced from the trade receivables. Reduced from the trade receivables and trade receivables carrying value is 95. Okay. Now if it is specifically mentioned as separate accounts, that is 100 crores is the trade receivables carrying value and there is an ECL having credit balance of 5 crore, then instead of in this journal entry, we passed to receivables 95. If both are appearing as separate accounts, then receivables will be derecognized as 100. Like in demerger, two fixed assets we credited gross block and provision for depreciation we debited. Yes or no? Same concept, 100 crores will be credited, provision for ECL will be debited, 5. Net effect will be the same. Here, even in the study material, they have simply written to receivables 95. Okay, yeah. Yes. So that's it. Now, then can you do partial derecognition? Can you do partial derecognition? What have you studied in case of partial derecognition? Maybe I would have not tried this in class. Question same question number 19 അല്ല ഇപ്പൊ ഇതേ derecognition ഏരിയയിലുള്ള question number 22 23 24 25 this is derecognition of liabilities, derecognition of assets, partial derecognition 27. See, what is the treatment when there is partial derecognition? What have you studied in case of partial derecognition? Partial derecognition. Can you do partial derecognition? Yes. Partial derecognition can be done only when specifically identifiable cash flows are Specifically identifiable cash flows are transferred. If there is a loan, from loan I have interest receipts and principal receipts. That loan itself I am not selling, but only the interest receipts I am selling. Then I can do partial derecognition. Or principal portion I am selling, then I can do partial derecognition. Or interest, 60% of interest is transferring, then it is partial derecognition. Or entire cash flows, principal and interest 60% I am transferring, partial derecognition can be done. Means partial derecognition can be done when specifically identifiable cash flows or proportionate share of all the cash flows are transferred, which means what we are trying to say is partial derecognition you can do only when fair value of cash flows transferred and fair value of cash flows retained both can be identified. When you are able to identify what are the present value, fair value of cash flows transferred and fair value of cash flows retained, both discounted at current market rate, both discounted at current market rate. When you are able to specifically identify it, then partial derecognition can be done. Are you understanding? Both discounted at current market rate, how much is the fair value of cash flows transferred, how much is the fair value of cash flows retained. When it can be specifically identified, partial derecognition can be done. Okay. If we are not able to identify how much is the cash flows transferred, how much is the cash flows retained, if there is a confusion, but some part is sold, there is a loan, interest and principal is there, some part is sold, some part is retained, but I don't know exactly fair value of cash flows transferred, fair value of cash flows retained, then we should do derecognition to its derecognition to its entirety. Then derecognition should be done fully, correct. Derecognition should be done in its entirety. Derecognition should be done in its entirety. Full derecognition has to be done. Okay, so this is an old RTP question. Now we don't have a question like this. We don't have a question like this in our study material. RTP, MTP, such a question has not asked. But ഒന്ന് പെട്ടെന്നൊന്നും ചെയ്ത് നോക്കാം ഒരു question RTP old question which is there. We'll quickly without wasting your time, let's quickly try this question. Listen. A Limited has given a loan to V Limited. Okay, A has given a loan to V Limited, 12% interest rate for 6 years, which is carrying at 25 lakhs and fair value 30 lakh 42,000. Why books it is 25 and fair value 30 lakh 42,000? And the fair value endana? What is carrying value? Carrying value of the loan is maybe, see, I have given a loan. We have given a loan. We have given a loan on 1st April 2020. What is the loan amount? 25 lakhs. On that date, what is the actual interest rate? Say 10%. What is the market interest rate? 10%. Then the loan will be accounted at 25 lakhs. Yes or no? Loan given is accounted at 25 lakhs. On 31st March 2021, loan interest has become 8%. In the books, still the loan will be accounted at 25 lakhs only. Will you change the amount? Subsequent market fluctuations, amortized cost will you consider? Because you are expecting to keep this loan for 5 years, full contract period, hold it till maturity, and no, you have no sale intention, only contractual cash flows. Even the borrower has to pay you 10% interest, even if the market rate is 8%. Yes or no? The borrower has taken loan from you at 10%. Even if the market rate has fallen, still they need to pay 10% interest, which means 8% does not have a relevance. Okay. Keta, Shraddhicha, should I repeat once more? Please respond. കേട്ടോ ശ്രദ്ധിച്ചോ റിപ്പീറ്റ് ചെയ്യണോന്നുള്ളതിനായിരിക്കും എന്നോ കേട്ടു. What about others? Yes. Yes. Okay. Now, if I have given a loan for 5 years, I have no plans to sell it in between. I have to hold it till maturity and I expect only contractual cash flows. But after 3 years, things have changed. 2021, 22, 23. Things have changed. Now I need fund immediately. So I am planning to sell this to a factor. Again, factoring arrangement? No. I'm planning to sell it to a factor. Okay. And now market rate of interest is 8%. Is it relevant? Is fair 8% relevant? Now 8% is relevant. Why? Because now this demand of this loan will be more, because if I buy this, if what is the concept? See, from the buyer's perspective, if I take a loan, if I given a loan of 25 lakhs, then in the 25 lakhs in a loan koduttal, what is the rate of interest I'll be getting? If I have given a loan of 25 lakhs to a party, what is the interest I'll get? Only 8. But if I buy this loan, I can get an interest of 10. So it is having more value. Now the fair value of that loan is having some importance. That market rate of interest is having some importance. So come back. What is this example? Here in my example, I was telling you. Come back. A Limited has given a loan at the rate of 12% for 6 years. Books, I said 10%, but here it is 12%, 25 lakhs. Okay. And fair value 30 lakh 42,000 is market value of this loan now is, which means the market rate of interest would have reduced. The market rate of loan is 30 lakh 42,000. Okay. To mitigate the risk, but at the same time retaining control over the loan, A transferred its right to receive principal amount of loan on its maturity with interest after retaining rights over 15% of principal and 2% interest that carries fair value respectively. The consideration for the transaction was 24 lakh 80,000. What does that mean? There are some risks involved. So I want to sell, I want to mitigate that risk at the same time to retain the control of the loan. A transferred. What is transferred? Principal amount of loan on its maturity with interest. After retaining rights over 15% of principal and 2% interest. Or 15% of interest we retained, 2% of principal also, 2% of interest also we retained, having a fair value of 74,000 and 4,50,300. 5,24,300. This is the fair value of cash flows retained. Consideration, we sold it for 24 lakh 80,000. Interest component retained include 1% of principal and interest having fair value of 1,40,200. Defaults, if any, are deductible to a maximum extent of the company. You are required to pass journal entries for derecognition of the loan. Now listen, if I ever get a question like this, my point number 1 should be, what is the fair value of cash flows retained? I need to get the bifurcation. What is the fair value of cash flows retained? Fair value of cash flows retained is 15% retained, 2% retained, it is 74,000 plus 4,50,300. 5,24,300 is the fair value of cash flows retained. Now find out what is the fair value of cash flows transferred. Fair value of cash flows transferred. Total fair value is 30,42,000 minus 524,300 is retained. So 25,17,700 is transferred. ഇത് മനസ്സിലായോ ഈ പോയിന്റ്? Did you understand? So retained നുള്ള principal, interest ഉള്ളിൽ again ഒരു 1% fee, whatever it is. Total fair value of cash flows retained is this. Fair value of cash flows transferred is total minus what is retained. ഇത് കിട്ടി. Okay. Now what should I do? Derecognition entry. ഞാൻ വേറെ ഒന്നും പറയുന്നില്ല. Derecognition entry. You derecognized a part, this 25,17,700 part at 24,80,000. So bank account debit, you got, when you derecognized, you got, or when you transferred, you got 24,80,000. Okay. To loan. എത്രയാണ് ലോൺ derecognize ചെയ്യുക? How much is the loan that will be derecognized? 25 lakhs into 25 lakhs is the total carrying value, of which how much will be derecognized? In this proportion, 25 lakh 17,700 divided by 30 lakh 42,000. 25 lakh 17,700 divided by 32 lakh 42,000 into 25 lakhs. The amount that will be derecognized is equal to amount that will be derecognized is equal to 20 lakh 69,116. Balance will be to gate. എന്താ ഭയങ്കര സൈലൻസ് ആണല്ലോ. അപ്പൊ എന്ന് നോക്കട്ടെ എങ്ങനെ ആൻസർ ചെയ്താ. ഇവിടെ നോക്ക്, ലിസൺ. In case of partial derecognition, identify fair value of cash flows transferred, identify fair value of cash flows retained. ഇത് പഠിച്ചോ? ഒന്നും പഠിച്ചൊന്ന് ക്ലോസ് ചെയ്തേ. Derecognize proportionate share of cash flows transferred. So cash flows transferred is 25 lakh 17,700. Cash flow retained is 5 lakh 24,300. So derecognition entry is bank, you received 24 lakh 80. To loan 25 lakhs I break. 25 lakhs carrying value. Fair value is 30 lakh 42,000. And there is 30 lakh 42,000 is breakup, I know, 5 lakh 24 something, 20 lakh. In that ratio, I'll break this. മനസ്സിലായോ? Why you are not responding? മനസ്സിലായോ? ഒന്നുകൂടെ പറയണോ ഇത്? അത്ര ക്വിക്ലി ആയി, because ഇത് ക്വസ്റ്റ്യൻ ബുക്കിലൊന്നും ഇല്ലാത്തതുകൊണ്ട് I was thinking why should I. ഞാൻ ഓഡിയബിൾ അല്ലേ ഇനി? എന്തെങ്കിലും പ്രശ്നമുണ്ടോ? മനസ്സിലായിട്ടില്ലേ? Should I explain this once more? explain this once more, Ano? Yes, sir. Yes, once more. Huh? Once more. Okay. അതായത് when there is a partial derecognition. Okay. When there is a partial derecognition, partially you sold a portion. Partially. What is partial derecognition? A portion you sold, a portion you retained. That is what? That is when we are going to do partial derecognition. A portion you transferred, a portion you retained. Okay. Okay. Hmm? So now what can I assume carrying value and fair value of that asset will be same? Can I assume carrying value? In my books, that asset is having one value. Market asset is having one value. Can I assume it is the same? No. Because in the books, based on the original interest rate on that date's market rate of interest, accordingly, books asset will be recorded at, in this example, 25 lakhs. But in the market, this loan is having a fair value of 30 lakh 42,000 based on the cash flows discounted using the current market rate. 30 lakh 42,000. Okay. Okay. അതുവരെ okay ആണോ? Okay. Now what is to be done? Now what is to be done is you should calculate whenever there is partial derecognition. You should calculate what is the first step whenever there is partial derecognition? Identify the fair value of cash flows transferred. Identify the fair value of cash flows retained. മനസ്സിലായോ? അപ്പോൾ ഇവിടെ identify the fair value of cash flows transferred. Identify the fair value of cash flows retained. In this question, what they were saying is A Limited transferred the rights to receive principal amount of loan on its maturity with interest after retaining rights over 15% of principal and 2% interest. അതായത് ആ 15% പ്രിൻസിപ്പലിന്റെയും 2% ഇൻട്രസ്റ്റിന്റെയും പ്രസന്റ് വാല്യൂസ് ആണ് ഈ കാണുന്നത്. മനസ്സിലായോ? ടോട്ടൽ പ്രസന്റ് വാല്യൂ ഓഫ് ക്യാഷ് ഫ്ലോസ് ആസ് പെർ ദ new rate is 30,42,000. Okay. And present value of cash flows we are retaining is this. ഈ രണ്ടിന്റെയും കൂടെ ടോട്ടൽ. അതാ ഞാൻ പറഞ്ഞ ടോട്ടൽ മതി നമുക്ക്. So what is the fair value of cash flows I am retaining? 5,24,300. മനസ്സിലായോ? അപ്പൊ what is the fair value of cash flows transferred? 25,17,700. Oh, I need to break it into how much cash flows transferred, how much cash flows retained. I got the proportion. എത്ര proportion I am transferring, എത്ര proportion I am retaining എന്നുള്ളൊരു bifurcation കിട്ടിയില്ലേ? I am getting that bifurcation. Yes or no? Yes. Now you pass entry for derecognition. What is the entry for derecognition? Bank to loan. Bank, I sold it. What is the amount you got? 24,80,000 I got. Okay. How much is the loan to be derecognized? Carrying value of my 100% of loan alle 25 lakhs. 25 ലക്ഷം എന്ന് പറയുന്നത് 100% ലോണിന്റെയും carrying value അല്ലേ? Yes. അതിൽ എത്ര proportion ആണ് ഞാൻ ട്രാൻസ്ഫർ ചെയ്യുന്നത്? It is 25,17,700 out of 30,42,000. Total fair value minus fair value transferred. The proportion, this proportion. So, അതാണ് എനിക്ക് കിട്ടിയത് 25,17,700 divided by 30,42,000 into 25 lakhs. Same proportion I derecognized. So, balance is my gain. Did you understand it now? ഞാൻ ആക്ച്വലി ഇത്ര സ്പീഡിൽ പറഞ്ഞത് എക്സാമിനും വന്നിട്ടില്ല, സ്റ്റഡി മെറ്റീരിയലും ഇല്ല, സിലബസിൽ പക്ഷെ ഇത് തിയറി ഉണ്ട്. വി ഹാവ് തിയറി ആൻഡ് ദർ ഇസ് എൻ ഓൾഡ് RTP ക്വസ്റ്റ്യൻ. വൈ ഷുഡ് ഐ ഡിസ്കസ് ഓൾ ദിസ് ഇൻ മാർ റിവിഷൻ ക്ലാസ് എന്നോർത്താണ് ഞാനത് ക്വിക്ലി പറഞ്ഞു പോയത്. ഓക്കെ. Okay, I hope it is clear. ഇത് ഓൾഡ് സിലബസിൽ 2-3 പ്രാവശ്യം വന്നിട്ടുണ്ട്. ബട്ട് സ്റ്റിൽ ഇറ്റ് ഇസ് നോട്ട് ദെയർ ഇൻ അവർ ന്യൂ സിലബസ് ബുക്ക്. ബട്ട് ഒന്നും നത്തിങ് ക്യാൻ ബി പ്രിഡിക്റ്റഡ്. ചിലപ്പോൾ ദേ ക്യാൻ ആസ്ക് ദിസ് ഇഫ് ദേ ഫീൽ ദിസ് ഷുഡ് ബി ടെസ്റ്റഡ് എന്ന് തോന്നിയാൽ ചിലപ്പോൾ ചോദിക്കാം. സോ ഡീറെക്കഗ്നിഷൻ വി ഹാവ് ദിസ് embedded derivative 22 17 18 രണ്ട് ക്വസ്റ്റ്യൻസും കൂടെ ഉണ്ട്. 1 second, just a second. Let me show you an example. Derecognition. See, question number 13. Derecognition. Quickly. എന്തായാലും ഇത്ര ആയ സ്ഥിതിക്ക് ഇതും കൂടെ ഒന്ന് വേഗം പറഞ്ഞിട്ട് we'll close. On 1st April 2012. Okay. On 1st April 2012, X Limited acquired corporate bonds at their face value of 50 lakhs. We acquired corporate bonds. So corporate bond is asset. You acquired at their face value of 50 lakhs. Pay 8% interest and redeemable at par at the end of year 10 on 31st March 22. On 31st March 16, when the market rate was 16%, fair value of bond is standing at this value. And the present value of interest, present value of principal is given. On the same date, X Limited unconditionally transferred its rights to principal to a bank under a legal assignment for a cash payment equal to its fair value. At fair value, we sold it and we retained the interest. What is the amount to be derecognized? Past journal entries. Can you just make a try and give the journal entry for this? This was a 4 marks question again. Okay. So I am checking total fair value is how much? Carrying value is 50 lakhs. Total fair value is this, and they have given the breakup of this. 19 lakhs, 50 lakhs into 50 lakhs into 35 lakh 24,802 divided by 54 lakh 91,732 is the amount to be derecognized. 35 lakh 24,802 divided by 4,71,732 into 50 lakhs. 32 lakh 9,189 or 190. 50 lakhs minus 32 lakh 9,190. 17 lakh 9810. 1 second. This is the amount to be recognized. What was the figure Krishna Priya was saying? 17 lakh 9810 is the gain. 17 lakh. So bank account debit. And they are telling sold at what figure? Sold at fair value. So bank account debit 35 lakh 24,802 to lot 32 lakh 9,190 to gain difference. Balance 3 lakh. Okay. 17 lakh, the difference is the amount retained. Yes, gain is what? Gain is the amount which you are giving now. 3,15,612 is the gain. മതി ഈ ഏരിയയിൽ ഇനി ഇരിക്കരുത്, ഇതൊന്നും നമ്മൾ സ്പെൻഡ് ചെയ്യരുത്. മതി, we are moving on. Okay, derecognition of financial asset, enough. അതൊന്നും നമ്മുടെ ഏരിയ അല്ല. So partial derecognition, if any condition is satisfied, you should go for partial derecognition. Specifically identified cash flows are transferred, or proportionate share of cash flows are transferred, or proportionate share of specifically identified cash flows are transferred, then you should go for partial derecognition. Okay. Now hedge accounting, before hedge accounting, derecognition, extinguishment, modification, derecognition, partial derecognition, hedge accounting, impairment. Let me quickly read this. Let me close this impairment. So impairment, in the theory, let me quickly discuss. Financial guarantee we'll try. Rest theory we'll quickly discuss and close. Because exam point of view, നമ്മൾ ക്ലാസ്സിൽ വെറുതെ one questions ചെയ്യുന്ന പോലെയല്ല. Exam revision point of view, I don't know whether it is relevant, because I need to do the practice additional questions also. So quickly listen. Impairment of financial asset. What do you mean by impairment of financial asset? See, financial assets which are recognizing at amortized cost, or some financial assets, debt instruments which we are recognizing at FVTOCI. Some assets can have impairment. Because why not FVTPL? You said FVTOCI, you said amortized cost. Why not FVTPL? FVTPL, otherwise also, if we receive some amount, we'll recognize in gain or PNL. Otherwise, always held for trading item. Always recorded at what value? Fair value, which is held for trading, which will be immediately sold. You will not recognize any provision for bad and doubtful debts. So here, yeah, ECL. So this topic is for financial assets generally which we record at amortized cost. We expect contractual cash flows. FVTOCI also you expect contractual cash flows. Yes or no? If it is FVTOCI also you expect contractual cash flows. Yes. So in such cases, sometimes your contractual cash flows is 100. But now because of some other reasons, the expected cash flows is only 75. So 100 was the contractual cash flows, but expected cash flows is only 75. The present value of this loss is what called as present value of expected loss is expected credit loss. Oh, that is what the process is. Impairment testing. Loss allowance, we are providing for the loss. Expected credit loss, all these terms are for the same item, which is nothing but our own provision. Okay. ECL is computed after estimating the probability of default. First you find out the loss rate. What is loss rate of a probability of default? With reasonable and supportable assumptions and without undue cost or effort. Okay. So what is this? See, this standard talks, this ECL, in the standard, what they are telling is ECL is computed. You identify loss rate, 25%, 10%, 5%, loss rate you identify, and using supportable and reasonable assumptions without undue cost or effort. To determine provision, don't go for investigation. അല്ലാതെ വലിയ ചെലവുകളൊന്നും ഇല്ലാതെ തന്നെ without any efforts, without due cost, if you identify any losses, you recognize ECL. But remember, ECL is at present value. Okay. So here, present, what is loss rate? Loss rate is equal to present value of loss, expected loss, divided by carrying value is equal to loss rate. Or ECL is equal to carrying value into loss rate. Okay, ECL is equal to, what is the carrying value? 25,000. Into how much is the loss rate? 2%. Okay, this is the ECL. So how do we calculate this loss rate? Find out the present value of loss expected, which means present value of contractual cash flows minus expected cash flows difference. This is what amount you are determining as the loss rate, identifying as the loss rate. Okay. Okay. Then ECL can be this expected credit losses can be for 1 year or for lifetime. Lifetime means entire contract period, entire term. The loss is not, it can be for 1 year or it can be for the entire term. It can be for the entire term or it can be for 1 year. So when do you create 12-month ECL? When there is significant risk on the reporting date. On 31st March, there is significant risk. Then 12-month ECL is created and loan amount is, receivable amount is 100 lakhs. Okay. Opening 100 lakhs is receivable. Interest rate is 12%. And now there is an ECL of 5 lakhs. Now the question is, should interest be recognized on 100 minus 5? 95 lakhs interest income recognized or on 100 lakhs? If it is 12-month ECL, there can be a doubt. Should I deduct ECL and recognize interest or recognize interest and deduct ECL? What is to be done? Interest, if it is 12-month ECL, interest should be recognized on gross. Interest should be recognized on the gross value. Interest should be recognized on the gross value. Interest should be recognized on the gross. Okay. Now, what about lifetime ECL? Entire term is affected. There is significant risk on the reporting date. There is significant risk on the reporting date. Okay, there is significant risk on the reporting date. And risk has significantly increased from inception. Initially, there was no such risk, but now that person has become bankrupt. Initially, he had net worth, but now it's like we got a new information that he is bankrupt. And there is evidence of impairment. If evidence of impairment is received, it is significant risk. You will not get that payment. So, interest, create ECL, net amount undengi matram, you can recognize interest. 100 lakhs is receivable, of which you will get only 10 lakhs, or say for example 90 lakhs is loss, you will get only 10 lakhs. On 10 lakhs you recognize interest. Interest should be recognized on the net value. Interest can be recognized on the net value. Okay. But if impairment evidence is not received, if you have not received impairment evidence, interest will be still recognized on gross value. Okay. So I am not trying questions on this. Like basic class questions, study material questions we have tried. That's enough. We are not trying questions on impairment. Why? Because contents great, there is nothing to be done. Okay, revision point of view, that is not required. Now, what is the treatment of financial guarantee? Financial guarantee we feel important. What is the treatment of financial guarantee? Financial guarantee means you have given A Limited a company, B Limited another company. A Limited has taken a loan. A Limited has taken a loan from bank. And B Limited has given financial guarantee. So A is the borrower and B is the guarantor. And bank is the lender. What is the accounting? There is nothing to be discussed in the books of lender. Something we will discuss in the books of borrower. and our discussion is in the books of this. Main discussion is in the books of B Limited. Okay. A has taken a loan from a bank. And what is the accounting in the books of guarantor? What is the accounting in the books of guarantor? Guarantor is giving a financial guarantee. Yes or no? Guarantor has given a financial guarantee. Guarantor has given a financial guarantee. So what is the accounting in the books of guarantor? There are two options. Guarantor collects commission. No commission is collected. There are two possibilities. We have collected commission. Second possibility, we have not collected any commission. So, if we collect commission, what will be the journal entry? They are telling commission amount will be equal to fair value of interest savings for the borrower. Commission amount will be equal to fair value of interest savings to the borrower. Fair value of interest savings to the borrower. Fair value of interest savings to the borrower. Yes. What is the benefit for the borrower because of this financial guarantee? If there is no guarantee, bank will charge higher interest rate. If there is no guarantee, bank will charge higher interest rate. If there is guarantee, bank will charge lower interest rate. So the savings, the guarantor will collect the present value of interest savings from the borrower. If collects commission, the entry will be bank account debit to financial guarantee at fair value. We collect that fair value bank to financial guarantee. Are you understanding? Yes. If commission is not collected, then if commission is not collected, you should still record financial guarantee, and debit aspect should be based on the substance of the contract. Why did you not collect commission? Why did you not collect commission? Okay, if you're acting as the guarantor of your employee, then it is prepaid employee benefit expense. Are you understanding? Difference should be accounted based on the substance of the contract. In the study material, there is only one question. Guarantee is given to subsidiary. So debit should be given to investment. Debit should be given to investment in subsidiary. Okay. Okay. So financial guarantee, first point, financial guarantee, initially it will be recorded at fair value. What is fair value? Present value of cash savings to the borrower. Present value of cash savings. Present value of cash savings to the borrower. Present value of cash savings to the borrower. Interest savings to the borrower. Did you understand? Present value of interest savings to the borrower. Okay. Now, initially this is the entry. Now question, is there any accounting in the books of borrower? Is there any accounting in the books of borrower? Beneficiary. Borrower, we also call it as beneficiary. The one who got the benefit of that guarantee. Is there any accounting in the books of beneficiary? Reply them. Yes. Okay. What is the accounting in the books of beneficiary? If paid commission, not paid. If not paid, no treatment. If not paid, no treatment. If not paid anything, no treatment. But if you paid commission, it will form part of TC. What is TC? It will form part of TC. What is TC? It will form part of TC in the TC. TC transaction cost. എന്താ പറയാത്തെ? Transaction cost. So transaction cost. If you paid commission to form part of transaction cost, I see. Yes, it will form part of transaction cost, and you need to calculate EIR liability. Like you need to adjust, and accordingly you need to calculate the EIR. That's it. Okay. Okay. അത്രേ ഉള്ളൂ. So what is the accounting in the books of guarantor? If guarantor is collecting commission, bank to financial guarantee not collecting commission, still you should recognize financial guarantee, investment to financial guarantee. What is the accounting in the books of beneficiary or borrower? Borrower, if paying commission, it is transaction cost. Accordingly, treat it as transaction cost and find out EIR. If not paid, then there is no treatment in the books of borrower. No treatment. Okay. Now, what is the accounting? Okay, bank to financial guarantee we accounted in the books of guarantor. Is there any further accounting in the books of guarantor? In the books of guarantor, is there any further accounting? Yes. What is the further accounting in the books of guarantor? In the books of guarantor, subsequently recognize it at fair value, that is higher of, very important, higher of. I used to tell you, wherever you find higher, where you are finding higher, that is I used to say in impairment in Ind AS 36. Recoverable value is fair value less cost to sell, and value in use, whichever is higher. Business combination, pre-combination expense, vesting period, original vesting period, revised vesting period, whichever is higher. Financial guarantee, subsequent accounting, present value of future cash savings, or probability of default, whichever is higher. So financial guarantee should be subsequently recorded at whichever is higher, and gain or loss will be transferred to statement of P&L. Gain or loss will be transferred to statement of P&L. Okay. Reclassification again. This. Let me take that financial guarantee question quickly. One question only there in our books. So that one, let me quickly read. Or I'll take that November 22. November 22. We have only one question in our study material, and that came in November 22 exam. This is May 22. May 22. Actually, this question I wanted to discuss. May 22. This question let me read this. X Limited has made a borrowing from RGD Bank for 20,000. It's a financial guarantee, it's a financial liability question. But this one, നമ്മുടെ book practice questions. Look, there are two questions on this. But quickly listen. This is May 22. 5 marks. X Limited made a borrowing from RGD Bank 20,000 at a fixed interest rate of 12%. Loan processing fees is 1,000. Loan repayable in 5,000 for a half yearly installments. Loan amount 20,000. Date of loan, finishing date, repayment from 30th September, to be paid half yearly. Repayment of loan. So 20,000, if there is a loan of 20,000, I should pay 5,000, 5,000, 5,000, 5,000. Okay, for installments. But interest, yeah, that is what coming. Installment amount is 5,000. Interest rate is 12%. Interest to be charged and paid quarterly. Oh, interest to be charged and paid quarterly. Upfront fees 1,000. Compute interest to be charged to the statement of P&L every quarter, and effective interest is 16.6%. So interest is Q1 interest will be how much? 20,000 into 12 into 3 by 12. Every quarter you need to pay 4 quarters. So first quarter interest will be 20,000 into 3%, 600. Second quarter interest will be 600. Third quarter interest will be 15,000 into 3%. That is 450. Q4 interest to be paid is 450. Q5 ഇല്ല year 2 year 2 year 2 Q1 interest is ഇതൊന്ന് ഇങ്ങനെ കറക്റ്റ് ആയിട്ട് എടുക്കണം. ഇത് മനസ്സിലായോ? Repayments, when you take one time, if you see, you won't make a mistake. Repayments will be like this. So that answer you should write as per Ind AS 109. Okay. The loan is initially recorded fair value. Market rate of interest is not given. So 20,000 minus transaction cost. The market rate of interest is not given. Hence fair value is 20,000. Loan is to be recorded 19,000. Now interest, because it is quarterly basis, we are doing it on quarterly. Finally, we are doing it on quarterly basis. So interest will be charged 4.15. How did you get this 4.15? Because EIR is 16.6. 16.6 divided by 4. So 19,000 into 4.15%, 789. Repayments, I should give importance. Closing balance, they are asking what is the interest expense and repayments. 4 marks in the 4 or 5 marks in the question. So what are the repayments? I should do this table. Compute interest to be charged to statement of P&L. That is this. So 19,000 plus 789 minus 600. 19,189. So 19,189 into 4.15% minus 5,600. 14,385. Repeat this. Finally, it will be nil. Are you okay? എങ്ങാനും ആ question വന്നാൽ this is to be done. ഈ 22 അല്ല, November 22. Question number 4A ആയിരിക്കും. For last few attempts, we used to get 4A. 4A. Just 12 marks. Quickly, November 22. On 1st April 21, Fortunate Bank has provided a loan of 25 lakhs to Mohan Limited. Okay. For 4 years at 10% per annum. And the loan has been guaranteed by Surya. Who's Surya? Which is the holding company for Mohan. So holding company has given a guarantee to subsidiary company. So holding company will not collect. See, it's given interest payments are made at the end of each year. Principal is made at the end of long term. If Surya had not issued the guarantee, Fortunate Bank would have charged an interest rate of 14%. So how much is the interest savings? 4%. Surya does not charge Mohan for providing guarantee. Oh. On 31st March 22, there is 2% probability that Mohan may default on the loan in the next 12 months. Even if the Mohan defaults on the loan, Surya does not expect to recover any amount. 31st March, there is 4% probability that Mohan will default. Then there is 5% probability that Mohan will default. You are required to provide accounting treatment for financial guarantee in the books of holding company. Very easy, okay. I'm going to try this here. So first step. Loan 25 lakhs in the books of Surya. Limited. Initially, loan should be recorded at higher of. Higher of. Higher of. Mm, 1 second. Loan will be recorded at initially higher of initially loan will be recorded at, you should write 25 lakhs into 14 percentage, 25 lakhs into 10 percentage. 25 lakhs into 14 percentage, 3,50,000 will be the interest. Here it is 2,50,000 will be the interest. So 1 lakh is the savings into annuity factor at which rate? Annuity factor at market rate, 14 percentage for how many years? 4 years. So 1 divided by 1.14, 1, 2, 3, 4, MRC 2.9137, 2.9137 into 2,91,370 is the fair value of this financial guarantee. What is the journal entry? Investment to financial guarantee. 291,370. 291,370. Yes. Then subsequently this will be recorded at subsequently. Record value subsequently it will be recorded at. So what my standard says is prepare the amortization table. Present value of remaining cash flows madi. But examiner, if I do opening 291,375, 370, 291,370 into 14%, 40,792. First year benefit already received. How much is the benefit received? 1 lakh. Closing balance is 291,370 plus 14% minus 1 lakh. Closing balance is 232,162. Yes or no? Which is equal to present value of remaining cash flows. Hey, what are you doing? We are preparing an amortization table. Here we are preparing an amortization table. 291,370. Here 1, 2, 3, 4. Okay. Interest rate at 14%. First year benefit already enjoyed. 1 lakh. So closing balance 232,168. Then 232,168 into 14%. 32,503. 1 lakh. One lakh 671. 1,64,671 into 14%, 23,000. Instead, we can do present value of remaining cash interest savings. Study material, this is the calculation. So, you all would have different, maybe, I don't know. So, that is why 1,87,725. 87,725. 1 lakh. So what is this figure? Subsequently, year 2, I'll find out. Year 2, what is the present value of future cash savings? 232,168. What is the probability of default? 2% of 25 lakhs. 25 lakhs into 2%, 50,000. Whichever is higher, 232, 168. So my investment is financial guarantee is already at 2,91,370 minus 232, 168. What is the journal entry I should pass? Year end. And the year end entry? Financial guarantee value should reduce. Financial guarantee should be recorded at higher of interest savings, the present value of remaining savings, and probability of default. ഞാൻ നോക്കിയപ്പോൾ ഇന്ന് ഫിനാൻഷ്യൽ ഗ്യാരണ്ടി ഇങ്ങനെ ഒരു ഗ്യാരണ്ടി കൊടുക്കുകയാണെങ്കിൽ present value of remaining savings ആണിത് 232, 168. Or you should calculate default, probability of default, whichever is higher, 232, 168. So I'll pass the entry financial guarantee to P&L 59,202. Okay, then 3. Year 3, repeat. Why did you prepare amortization table? Year 2, fair value financial guarantee 164,671. Year 3, 164,671. On the beginning of year 1, okay, 164,671, 164,671, and probability of default has become 4%. So 25 lakhs into 4%. 1 lakh. Whichever is higher, 164,671. So what is the entry? Financial guarantee to P&L. $67,497. Are you understanding this? So financial guarantees are FVTPL instruments. Financial guarantees are FVTPL instruments. Financial guarantees are FVTPL instruments. So subsequently you always measure whichever is higher, accordingly you measure this. Finally, so financial guarantees at fair value 291,370, investment to financial guarantee. Then we are preparing this. You can either prepare amortization table or you may go for present value calculations every year. So if I prepare this amortization table, every year financial guarantee to P&L, financial guarantee to P&L, financial guarantee to P&L, last date of loan on the maturity. If there is no default, present value of remaining cash savings nil, probability of default nil, then entire financial guarantee can be reversed to P&L. Are you understanding? Yes. But there is default. There is default. What is the present value of future interest savings? Nil. What is the probability of default? There is default. Say for example, ഒരിക്കലും 25 lakhs default വരില്ല. Entire loan amount cannot be a default. Why? Why? Because if that is my subsidiary, if there is a difficulty for subsidiary to repay, that I can smell it from the starting itself, or maybe at the end of third year, at the end of beginning of or second year or third year. എനിക്ക് അതിനെപ്പറ്റി ഒരു ക്ലൂ ഉണ്ടാവില്ല. Accordingly, if the entire amount is to be defaulted, means I'll be already recognizing financial guarantee liability. Yes or no? If there is a default, if just for if there is a default, I'm just for your understanding, I'm telling, if 25 lakhs is defaulted, no doubt financial guarantee balance, entire loss on settlement will be transferred to P&L to bank. There is no possibility for this. If at all such possibility arises, No doubt, this financial guarantees are FVTPL instruments, hence it will be transferred to P&L. മനസ്സിലായോ? Okay. So reclassification, regular way of purchase and sale. Just by, again, a question has not yet asked a theory area. Can you just simply go through it? And if there is a doubt, we'll discuss. But otherwise, I don't think that I need to spend some time on this. Look at was 7% charge on it. And let me quickly, or let me go through that additional questions now. You will study our financial instruments chapter today, and if there is a doubt, you will come up with your doubt tomorrow. Any question I need to try, you will put in the group. So അങ്ങനെയൊന്നും ഇതുവരെ ആരും ചെയ്തിട്ടില്ല, അത് വേറെ കാര്യം. ചെയ്യുമായിരിക്കും. Let me read these questions. അല്ലെങ്കിൽ ഇതൊക്കെയാണ് important rather than that small theory. Only 6 questions are asked. 6 questions are added for the time being. So the 6 questions I'm going to read now. These are all the 6 questions are new. Nothing from the already there. So it is added. അങ്ങനെ ഒരു area പോലും ഇല്ല. So can I read this? വായിക്കട്ടെ? Yes. പിന്നെന്താ? അപ്പോൾ I'm taking that 6 additional questions now. On 1st April 2000, okay. Chapter 11. So listen. Accounting and reporting of financial instruments. On 1st April 2000, on 1st April 2011 or 2001, Entity X issued a 10% convertible debenture with face value of 1000 maturing on 31st March after 10 years to 31st March 2011. The debenture is convertible into ordinary shares at a conversion price of 50. Are you focusing? You had debentures. These debentures are having a face value of 1000. It is maturing on 31st March 11. The debenture is convertible into ordinary shares at a conversion price of 50 per share. Interest is payable yearly in cash on 1st April 2002. That is second year. To induce the holder to convert the convertible debenture promptly, Entity X reduces the conversion price to 40 if the debenture is converted before 1st June within 60 days. The market price of X ordinary shares is on the date of amendment is 80. How will the revised terms be accounted? Did you understand the question? No, I didn't understand the question. Okay. You had issued a debenture of 1,000 rupees. And what is the conversion price agreed? This is a convertible debenture. Conversion price agreed was 50. Now, after 1 year, you want more equity. You want the debenture holders to exercise for this equity shares. Conversion option edukkanam. So you have uh, amended the conversion price to 40. You have amended the conversion price to 40. So does it have any impact in your books of accounts? Does it have any impact? Yes, there is an impact. That is before how many, it will be converted to how many equity shares? 20 shares. Now it will be converted to how many equity shares? Now it will be converted to 25 equity shares. So you are giving 5 shares additionally. Yes or no? You need to give 5 additional shares. What is the value of that 5 additional shares as on today? Today, if I am giving that 5 additional shares, what is the value? 5 into 8, 400. 5 shares into 8. Let me take that 1 second. Yes. So here 80. So 5 into 80. How will the revised terms be accounted? ഭയങ്കര easy set of questions ആണ്. Fair value of incremental consideration. Earlier face value was 1,000. 40, which means 40 into 800 is the value. Sorry, not 40. 25 into 80 is the value of equity shares you are issuing now. Yes. Now, ordinary shares under the original terms, face value 1,000, original conversion price 50, number of ordinary shares 20, additional shares you are issuing is 5, value of additional shares is a loss for the company, which is to be recognized in P&L as a loss. So 400 rupees should be recognized as a loss. മനസ്സിലായോ? വെറുതെ ഒരു basic question, but can be asked in maybe ഒരു MCQ ലൊക്കെ what if they ask. So be clear. ഒന്ന് കണ്ടിരിക്കണം. That's it. Yeah. ഇനി ABC Limited issued. Okay. ABC Limited issued 4% 1 lakh OCPS. Ayyo, what is this OCPS? Optionally convertible preference shares. CCPS, compulsory convertible preference shares. It's optionally convertible preference shares at a face value of 100 per share on 1st April 2011, and these are redeemable after 5 years. Okay. Dividend is non-cumulative. Each preference share entitles the holder to 10 equity shares, and preference shares are optionally convertible by the holder at any time until maturity. It's okay. How will preference shares be classified at initial recognition, assuming that comparable instrument carries a market interest rate of 7%? Easy. So 4% is the actual interest, 7% is the market interest, and optionally convertible. You know what is the accounting? You know the accounting, right? We'll initially find out the fair value of liability. So 1 lakh minus fair value of liability is equity. Compound financial instrument as usual accounting. Yes. Provide journal entries for the year one. Ayyo, ഇത് ചോദിച്ചാൽ മതിയായിരുന്നു examine. They should ask this question. We'll try this. We'll do this. Okay. Now, will this classification be changed subsequently in case there is a likelihood that OCPS will be encashed at the end of maturity period? See, initially we accounted it as equity and liabilities divide ചെയ്തു. അതുവരെ clear ആണോ? Are you focusing? Yes. Subsequently, we think all these preference shares will opt for cash. അപ്പോൾ നിങ്ങളുടെ അക്കൗണ്ടിംഗിൽ എന്തെങ്കിലും ചേഞ്ച് വരണോ? No change. Otherwise, also, if it is optionally convertible, we believe that all these preference shares will opt for cash. Accordingly, maximum liability. Exactly. We have already recognized maximum liability. We are prepared for both. So, if there is more likelihood for cash or more likelihood for shares, no change, no subsequent changes. ശരിയാണോ? അയ്യോ, നിങ്ങൾ ഈ പറയുന്നതൊക്കെ കറക്റ്റ് ആണോ? അതെ. Trust me. OCPS is redeemable at the end of 5th year. Hence, preference shares contains liability component. കുറേ കഥകളൊക്കെ എഴുതിയിട്ടുണ്ട്. So, measurement. First, what we'll do, interest will be, uh, interest will be, uh, you will discount it using 7%. Fair value of financial liability will be computed. Okay. So fair value of liability is 71,29,862. Our fair value directly in the So equity is the balance. Correct. So on at the time of initial recognition, that calculation we are not doing because we have done it. Interest and principal. Yes. So bank account we got. OCPS liability, OCPS equity we split. First year end. Interest will be unwinded. This 71,29,862 into 7% is 4,99,090. Yes or no? Okay. So interest entry will be passed every year. And finally, interest entry will be passed every year till the conversion. When the option is exercised by the holder to equity shares, liability will be converted to equity or liability debit equity debit to share capital. Yes or no? Combined item will do liability debit equity debit to share capital, or else liability will be converted to equity. Share based payments പോലെ തന്നെ. And can you read the last? Everybody, can you please read this as per para 30? As per para 30, in case of a convertible financial instrument, the classification of liability and equity is not revised as a result of change in the likelihood. Subsequently, if there is a likelihood to opt for cash, likelihood for opt for equity, will it change the classification? No. So once you estimate the equity, it cannot be reclassified, it cannot be re-estimated. Yeah, we have studied this, I remember. Okay. Are you clear? Okay. Yes. Then 3. I thought again an MCQ, probable, an MCQ kind of question, which means they can ask this as an MCQ. So what is this? State whether the following items meet whether it is a financial asset or a financial liability. Okay, good. A bank advances an entity a 5-year loan. Bank also provides the entity with an overdraft facility for a number of years. Is it a financial asset or financial liability or whatever it? What is it? For the entity, entity, it's a financial liability because not from bank point of view. Financial asset or financial liability for the entity, it is a financial liability because there is a contractual obligation to pay cash in both the cases. Yes. Entity A owns preference shares in entity B. Okay. So, the preference shares entitles entity A to dividends but not any voting rights. Owns preference shares in entity B. Preference shares entitle entity A. So for entity A, it is a financial asset. For entity B, it can be equity or liability. What did you say? L in the liability. For entity A, it is a financial asset. Entity B, it can be preference shares can be equity or liability based on the terms. കുട്ടികൾ മിണ്ടുന്നില്ലല്ലോ. എന്തെങ്കിലും പറയണോ? Okay. What about the rest? ഇത് okay അല്ലേ? Yes. Now, an entity has a present obligation in respect of income tax. There is income tax payable. Is it a financial asset or liability? Income tax payable, not financial instrument at all, because it's a statutory obligation, no contractual liability, not a financial instrument. Wow. In a lawsuit, okay, a lawsuit brought against an entity, a group of people is seeking compensation for damage to their health as a result of land contamination. See, lawsuit, an amount is payable. Is it a financial asset or liability? Lawsuit, whatever the case is, think against the case or no. Is the financial asset or financial liability? Not a because there is no contract that is based on the verdict. How can it be financial asset or financial liability? It is a contingent liability. Contingent. It can be contingent asset or liability. So it does not create a financial liability, or there is no contractual liability. Okay. Oh. Why do we read that question? Because it is newly added, fresh. Or else we would have ignored that question. ശരിയാണ്. In an arm's length transaction, okay, in an arm's length transaction, entity X buys 10,000 convertible preference shares in Z for cash payment of 40,000 with 25,000 payable immediately and 15,000 payable in 2 years. Market rate of annual interest for a 2-year loan of the entity would be 6%. Explain the treatment for the said transaction. Oh, what is this? What is the entry? You bought 10,000 preference shares for 40,000, of which 25,000 you paid immediately, but 15,000 is payable. Very good. You are creating both asset and liability. There is a financial asset, convertible preference share, and there is a payable contractual liability to pay 15,000 after 2 years. So 15,000 you will be recognizing it after 2 years. 1 divided by 1.06. 0.88. 15,000 into 13,350. Okay, and answer on the answer to have more clarity on it. Since payment of 15,000 is deferred for 2 years, the consideration is 25,000 plus 13,350. You all got now 13,350 in the calculator. So we'll measure the fair financial asset. Preference shares will be measured at 38,350. Since this transaction took place at arm's length price, this is considered to be the fair value. The difference between 40,000 and 38,350 will be recognized as interest expense. It's like 115 in the type of question. Yeah, very easy. Very easy. Very easy. That is why I said there is no complicated, nothing serious. Very easy PC questions. We are just running through by taking very less time. Fine. SCL Limited, SCL has applied for a term loan from a bank for business purpose. As per the loan agreement, the loan required a personal guarantee of one of the directors of SCL to be executed. So you have taken a loan, okay, and you have you got a personal guarantee of one of the directors. In case of default by SCL, the direct will be required to compensate for the loss. Mr. Purejoy, what a name. Mr. Purejoy, one of the directors, had given guarantee to the bank pursuant to which the loan was sanctioned. SCL does not pay any premium or fees to its director for providing financial guarantee. So director has given it free of cost. What is the entry in the books of director? Director is not a company. Ind AS is not applicable. Nothing. No entry in the books of director. Whether SCL is required to account for the financial guarantee received from director. Will there be any disclosures as per Ind AS 24? What is Ind AS 24? Related party. So, is there okay, two parts to it. Is there an accounting in the books of SCL for this? SCL, the book, is there an accounting? No accounting. So you can write financial guarantee accounting notes. No accounting. If anything was paid, there it is transaction cost, but nothing is paid. No accounting, no effect. EAR will not be calculated. But it is a transaction with a director. So KMPs are related parties. Yes or no? KMPs are related parties. Yes, yes, yes. KMPs are related parties. So transaction with what are the disclosures? Amount of loan, date, actually full disclosures ആണെങ്കിൽ name of the related party, description of relationship, nature of transaction, amount of transaction, is there any outstanding amount, anything returned back, return off. Okay, okay. So question number 5 അല്ലേ? 5, financial guarantee contract. In the given case, it's a financial guarantee. Okay. Exercise. ഇവിടെ നിന്നാണ് ആൻസർ. അതുവരെ തിയറിയാണ്. ഇൻ ദ ഗിവൺ കേസ് SCL is the beneficiary of financial guarantee and does not pay any premium or fees. Accordingly, SCL will not be required to account for such financial guarantee in the financial statements. Okay. Now, amount of transaction, amount of outstanding balance, provision required, any bad debts return off, return back. These are the accounting treatments. Okay. Now, again, a normal question, easy question, question number 6. On 1st April 2011, a bank provides an entity with a 4-year loan, 5,000. On normal market terms, interest is 8%. Interest is payable at the end of each year. Figure of 8% is the market rate of interest. Transaction cost 100. So EIR is 8.612. Up to this is okay, right? You have taken a loan of 5,000. Transaction cost is 100. So you'll record the loan at what amount? You will record the loan at 5,000 ആണോ? 4,900 അല്ലേ? There's a transaction cost of 100. Yes, you will record the loan at 4,900. You will unwind the interest at 8.612%. 11-12 entity experienced financial difficulties. Ayyo. The bank agreed to modify the terms. Under the new terms, interest payments of 12-13 and 13-14. So 11-12. Next, first year is already over. 12-13 and 12-13 to 12-13, 13-14, 14-15 reduced. Entity paid the bank a fee of 50 for paperwork. Analyze whether this is extinguishment accounting or modification accounting. So what is the treat? See what we should do here. What are they asking? What we are expected to do? 10% test. We are expected to do 10% test. That's it. So what we should do first? Again, I'm not trying it. First year end. You can take first year end value 4921.99. This 4921.99 is the present value of original liability, original terms. Yes or no? 4921.99. Yes. The present value of revised terms. Present value of revised terms, new terms is equal to new interest rate. New interest rate 5,000 into 5% is the new interest rate. Yes or no? 5% into 4 year. Already 1 year is gone. Interest rate decrease means 250 and 5,000 250 new payments. Yes or no? അയ്യോ ആരും മിണ്ടുന്നില്ല, എനിക്ക് ടെൻഷൻ ആവണം അല്ലേ? 5,000 into 5%. ശരി, 5,000 into 8% ആയിരുന്നു ആദ്യത്തെ ഇൻട്രസ്റ്റ്. 4-year loan. It's a 4-year loan. 400, 400, 400, 5,400 ആയിരുന്നു. Now 1 year later they changed to 5%. 8% എന്നുള്ള 5% ആക്കി. So it has become 250, 250, 5,250. Yes or no? All of you should revise term and you should discount it using the original EIR. You should discount using original EIR. So 4537, and there is a 50 rupees you are paying. So it is 4537 plus 50 which you are paying now, 4587. So calculator eduthe, calculator la I'll compare 4921.99 original terms, 4587.25 revised terms, 334.74 divided by 4921 ആണോ 4587 ആണോ divided by 49. About how much is the percentage coming to? It is coming to 4921 difference എത്ര percentage coming to? Are you getting 6.8 percentage? 6.8, 6.6, 6.8 എനിക്കാണ് 6.8. Everybody is getting 6.8. So 6.8 percentage. So what is the answer? Modification account. So question accounting illa, whether it is extinguishment accounting or modification accounting. So it is 10% test. There is no, it cannot be considered as substantial modification. So therefore modification would be accounted, would not be accounted. Modification would not be accounted as extinguishment of original liability. Are you clear? So these are the new questions. New questions are actually ഭയങ്കര സമാധാനല്ലേ? New questions നോക്കുമ്പോൾ ഒന്നുമില്ല. ഭാഗ്യം. എന്തെങ്കിലും വലുത് എക്സാമിന് വരാനുണ്ടോന്ന് അറിയില്ല. But new questions added are financial instruments. I was looking forward. What are the kind of new questions? Hedge accounting ഉണ്ടോ? കാരണം hedging ഒരു questionും ഇല്ല. So far there is no question in hedging. So is there a hedge accounting added? What is the kind of question? But ഭയങ്കര ഒരു റിലീഫാണ് ഈ ക്വസ്റ്റ്യൻസ് ഒക്കെ നോക്കിയപ്പോൾ സമാധാനം. ഞാൻ അക്കൗണ്ട് ചെയ്യുമ്പോൾ TC കുറയ്ക്കണോ? ഇനി അക്കൗണ്ടിങ് ചെയ്യുമ്പോൾ old liability was 4921. What is the accounting? Okay. Old liability book value is 4921.99. So you should account liable. What is the account of modification? Legal fees to bank, loan to legal fees. So it is 4921 minus 50. 4921 minus 50. It is 4871.99. Now 250, 250, 5250. You should find a rate which matches 250, 250, 5250 with 4871. Then accounting. Okay. So accounting they are not asking. So I think it's fine. Okay. Okay. So that's it. Madi. So just go through financial instruments chapter. Overall നോക്കിയിട്ട് ഞാൻ സീരിയസ് ആയിട്ടാണ് നിങ്ങളോട് പറയുന്നത്. പഠിച്ചു കഴിഞ്ഞിട്ട് just put a photo in the group. നമുക്ക് വേണമെങ്കിൽ നാളെ അത് എന്തെങ്കിലും ഡൗട്ട് ഉണ്ടെങ്കിൽ അത് എടുക്കാം. We can take it tomorrow. Will you study? ഒന്ന് ഒതുക്കി വെക്കാനാണ് ഞാൻ പറയുന്നത്. Financial instruments is okay, all right. അങ്ങനെ ഒന്ന് ഒതുക്കി വെച്ച് കഴിഞ്ഞിട്ട് എന്തെങ്കിലും serious problems ഉണ്ടെങ്കിൽ just put it and we can discuss. Okay. Okay. Okay, so that's it. We'll see tomorrow. If everything is okay, we'll do nala one day we'll do 115 revision. 115. We'll try to close 115 tomorrow. We'll try to close 116 day after that. See, അല്ലെങ്കിൽ നമുക്ക് നാളെ സംസാരിക്കാം. Many of you have left. നമുക്ക് we'll discuss tomorrow. Thank you. Bye.